Right, if you all could take your seats, we can get going in another minute or so. Right, good morning everybody from the BCI team. Good morning and a warm welcome. Always great to see so many people in person. It's always a bit strange staring at a camera and a laptop screen when you present. It's much nicer to look people in the face and to see if they're actually there and not off doing something else. From Robert Walton, Amelia, Tanya, Jade, Olga, and the entire BCI team, thank you so much for your continued support and thank you for being here this morning. Always great to have you with us. Before we get going, just very quickly, we've got the QR code on the screen now. For those of you who didn't scan in yet, please do so now. And remember, when you leave as well, scan out. But I always wondered, Olga, if you don't scan out, how does it work? Does it count then that you're just there all the time? All right, but anyway, please do scan out. We are recording this session. So if you have to get up and leave the room during the middle of presentations, please try to use the aisle seats. You heard the airport bell as well. So the exits is behind you, nothing on the wings. Right. Safe flights this morning. I had a couple of discussions with some of our presenters this morning, and it's interesting times. And I think conversations with clients is very easy at the moment. Everything is green. Fixed income is doing well. Equity is doing well. Global equity is doing well. I think the only market in the red at the moment is India. But we're not going to talk about India today. We're going to cover a lot of asset classes. We're going to cover SA fixed income, SA equity. We're going to touch on global equity as well. We're going to look at multi-asset funds. I always have fun with multi-asset funds because that's where we really get to see what asset allocation views are from some of these fund managers and how they blend questions about onshore, offshore. We're going to touch on things like currencies because, I mean, the dollar and the rand, lot to be said there, and where are we going, especially what the impact will be on your global carve-out, whatever that global carve-out will be. We've also touched briefly on property to see what SA property is doing, and then we're going to close off the end of the day looking at hedge funds, and how hedge funds can play a big role in client portfolios in mitigating risk as a diversifier in client portfolios. With that said, I think let's continue. Our first presenter for this morning, it's my absolute pleasure to welcome Simon Raubenheimer from Contrarius Asset Management, all the way from Jersey. About 2 weeks ago, you would have seen him one of the offshore webinars, and Simon normally presents on the Contrarius Global Funds, I think you're all familiar with. They recently launched a SA Multi-Asset High Equity Fund and an equity fund. So very interesting to see how you're playing in the SA space. But Simon, this is familiar hunting grounds from you, from your ex-Alan Gray days. I think it's been a decade since you last been in Pretoria. So really great to have you here. And I think a lot of our audience members here also recognize you from those times. So great to have you here, and we look forward to your presentation. Thank you so much.
It's always a big pleasure to be here. Thank you to BCI for the platform, and thank you to Eugene for wearing a tie and not making me feel like the odd one out. It's fantastic being back in Pretoria. I was born here, I grew up here, went to school here, went to study here. I've still got my old professor in the audience, so if my economic theory today is a little bit wobbly, then you speak to my professor here. So most of you will know Contrarius for managing global funds. You would have hopefully over the course of several BCI seminars heard us talk about our global equity and our global balance funds. What many of you don't know is that we recently launched South African funds, in fact, and I'm here to talk about those South African funds specifically. So I guess the first few questions, why did we decide to launch in South Africa? Well, the one thing, this slide here shows consumer confidence and business confidence. So business confidence in red and consumer confidence in blue. And you can see that the sentiment in South Africa is extremely negative, both from businesses, but also from consumers. Most people are finding conditions very tough and are pretty pessimistic about their outlooks. Again, that's both businesses and consumers. And you can see that that has been the case for for a number of years. So sentiment is very depressed. And you've had continued outflows from foreign investors. So the red line there, going back all the way to 2017, shows foreign net equity outflows on an annual basis, and the blue line there shows on a cumulative basis what's happened to foreign investments to equities in South Africa. And you could see over the past, that's kind of 7 odd years, almost R1 trillion has been taken out of the stock exchange just by foreign investors. And we look at what a lot of the local investors are doing. They're actually following suit. So they're also heavily invested in the rand hedges and the offshore stocks. And you see a similar sort of theme sort of unfolding when it comes to South African incorporated equities. You can also see there that the GNU last year made very little difference to foreign flows. And actually this year, they continue to run at more or less the same annualized rate that they were running at last year too. So outflows are bad, sentiment is poor, and as a result, the South African market, when measured in US dollar terms versus the MSCI World Index, has underperformed for a number of years. You can see it has started turning up more recently, but it's still only a blip on a sort of a longer-term chart. So as a contrarian investor, as a company who are drawn to things that are neglected or misunderstood or unloved, this is a market that naturally appeals to us. So that's why we launched in South Africa. I guess the second question is, are we able to do things differently to what everyone else in South Africa is doing? So what we've done here, and this graph requires a little bit of, this table requires a little bit of explanation. So the second column there shows the top 10 shares that are currently held in our South African fund. So it's Naspers. I've just put Naspers and Prosus together. So Naspers is our biggest share, Prosus is our 8th biggest share. The JSE is our 2nd biggest share, African Rainbow Minerals our 3rd biggest share, and so down the list we go to PPC Cement. What we did here is we looked at the Alexander Forbes 2024 survey, which is the most recent data we could get. And we said, we take the top 10 asset managers in South Africa, all right, and we grossed up their equities and their domestic assets under management by what markets had done. And then we said, if we just assume that 50% of their domestic assets are invested in shares. Okay, so it's not an exact number. I don't know whether it's 40 or 50 or 60%. We just said assume 50% of their South African assets are invested into equities. If these top 10 asset managers on average are extremely optimistic about these shares, and they were to buy 20% of each of these businesses, how big would each of those positions be in their, as a percentage of the shares that they manage? And you can see for a company like the JSE Limited, which has maybe a 12 billion rand market cap, if the average of the top 10 managers in South Africa were to buy 20% of the JSE, assuming 50% of their South African investments are sitting in equities, it would only make up 1% of their shares. Assuming they bought 20% of Sun International, again, a 11 billion odd rand company, it would only make up 1.1% of their shares in issue. Assuming they bought 20% of PPC Cement, it would only make up 0.7% of their domestic equities. So if they were very bullish on these companies that we think the valuations are cheap, it wouldn't move the needle for most of the larger guys in South Africa. And actually, if we look at the liquidity on the South African market, here we assume here that you buy 15% of the daily volume-weighted average price. 15% is what we utilize in our funds globally. We seem to find that's a level that works. You can buy at that level of, call it aggression, without disturbing the share price. So if you buy 15% of the daily volume-weighted average price, how long would it take you to buy 20% of each of those businesses? So to buy, and you can see for companies like the JSE, if they were to buy 20% of the JSE at 15% of the daily volume, it would take them 32 months to buy. It would take them 53 months to buy Sun International. Here we only look at the shares trading in South Africa. So for a Glencore, for example, Glencore shares are fully fungible between South Africa and London. So that's only the liquidity on the South African market. But for many of those shares like PPC Cement or Sun International, those shares don't trade anywhere else. This is how long you'd have to wait. 53 months if you bought 15% of the daily volume weighted average for a company like Sun International. So if you are bullish on Sun International, you have to buy it 4 years in advance. That's months, not days. That's how long it's going to take you to buy 20% of that position. So we think the market structure lends itself to a smaller manager, and we think we are sufficiently able to be very different to what everyone else is doing. I guess the third question is, are we willing to be very different? Well, again, I look at our top 10. Here we look at the top 10 holdings of, again, those 10 largest asset managers in South Africa. And we say, across all their portfolios, how different are they all looking? Well, 9 of them own Naspers, of the top 10 managers. 9 own Prosus, 9 of them own First Rand, 8 of them own Standard Bank, 7 of them own Anglo Gold Ashanti, and so down the list you go. So there's actually a tremendous amount of commonality amongst the top 10 asset managers in South Africa. The top 10s largely look more or less the same. Different weightings, but very, very similar. Again, we only own Naspers and Prosus. Our portfolios look very, very different. So yes, we are willing to be very different. You can look at our top 10, and again, you'd see Naspers there, and Prosus number 8 is the only overlap we have with the other managers, certainly the large managers. And when you look at it from a sectoral point of view, you look at what's in the benchmark, and you look at what's in our fund, you can see overweight basic materials, underweight consumer staples, for example, overweight consumer discretionaries. Again, our weights are very, very different to those that are held by the market indices and those held by the average manager. I guess the fourth question is, well, we think the market's attractive because it's unloved, it's out of favor. As you saw, you've had continued outflows. We think we are able to be very different. We think we are willing to be very different, as you can see, but can we outperform? So I guess the only long-term thing we can point towards there is the long-term track record of our global equity fund, which you can see there. We launched in 2009, and you can see our global equity fund in blue compared to the MSCI World Index, which is the average stock exchange around the world, and compared to the average manager there in black. And you can see, had you invested with the average manager in January 2009 when we launched, you would have made roughly 4 times your money. Had you invested with the MSCI World Index, so just had your money sitting in a low-cost tracking fund, you would have made around 6 times your money. And had you given your money to us to manage, you would have made around 9.5 times your money after fees. So again, we think we have demonstrated the ability to outperform over a long term, admittedly with some volatility, but as we always say, volatility, we feel, is the price of admission. And if you truly do look different, then your returns will be very different to those in the benchmark, and you will have some volatility. So what are the opportunities that we're seeing on the JSE? I'll just take you through 2 examples of the value that we see in the South African market. The first of those, here we look at a basket of stock exchanges. So here's the Intercontinental Stock Exchange, or ICE, the Chicago Mercantile Stock Exchange, the London Stock Exchange, the Hong Kong Stock Exchange. We've got the Australian Stock Exchange here. So this is a basket not of the indices, but of the actual operating businesses who run the exchanges. So these would be the competitors to the JSE Limited, right? And you can see, again, this is more or less the history of our global fund. Had you invested in these global stock exchanges, you would have made almost 8 times your money. So it's been a great place to be globally, is to own the actual stock exchange operators. But look at how the JSE has performed relative to that basket of stock exchanges. From a sort of a peak, that euphoria leading up to the 2010 World Cup, things have just fizzled out and gone down and down and down. And from that peak, the JSE is down probably 80 or 85% relative to that basket of international stock exchanges that I showed you on the previous chart. Again, as a contrarian investor, we like to own things that are out of favor. This to us looks pretty out of favor. The JSE is a great business, has a near monopoly in South Africa, similar to many of the other stock exchanges elsewhere in the world, but is trading, as you can see on this chart here, at substantial discounts to many of the other exchanges all around the world. So this again, shows a table of, there's the Chicago Mercantile Exchange. That's a $103 billion company. The LSE, the London Stock Exchange, is a $70 billion company. So these are massive exchanges all around the world. And you run down the table, you can see right down at the bottom, just below that average, there's a JSE, which is only a $0.65 billion company. So tiny, tiny. But look at the valuation of the JSE versus the valuation of these other indices. And here we've just pulled the Bloomberg consensus forecast numbers. These aren't even our forecasts. This is purely objective. On a 1 year forward price to earnings multiple, these other exchanges trade at between 25, 26 times earnings. You can see the average at 25.7. The JSE trades at a multiple of 10.9. That's an almost 60% discount to exactly the same business elsewhere in the world, right? And on a 2 year forward basis, we're again at an almost 60% discount to other exchanges elsewhere in the world. And of course, it's because of all these factors that we discussed earlier. The stock exchange, the South African markets had continued outflows. The markets are depressed. A lot of people aren't participating in the South African market to their full extent. And those things feed on themselves, and you're finding these tremendous opportunities of value on the JSE, which includes the JSE operating business itself. So that's one example. Another example in a completely different sector is African Rainbow Minerals. Now, African Rainbow Minerals is a mining company, and it's a bit of a conglomerate. It owns 75 million shares in Harmony Gold. Those 75 million shares in Harmony Gold, I've shaded in gray, are worth 100 Rand per African Rainbow Minerals share. In addition to those 75 million Harmony shares, African Rainbow Minerals has more than 20 Rand, actually 22 Rand per share of net cash. No debt, only cash. So if I take African Rainbow Minerals' stake in Harmony off its market capitalization, and I also subtract the net cash, and I look at what's left, that's that light blue line. So what's left is we call here the rump of African Rainbow Minerals. So those are iron ore mines in the Northern Cape, manganese mines. They've got 3 platinum mines. They've got coal mines. In a good year, the rump of African Rainbow Minerals plus the net cash, so all the assets excluding Harmony, in a good year, so back in 2021, those assets generate 60 Rand, more than 60 Rand per share for shareholders, right? You're currently only paying 80 Rand a share, so it's on like a 1 PE of peak earnings. And even in a more normalized year, it earns between 20 and 30 Rand a share for something that you're paying less than 80 Rand for. So it's like between a 3 and a 4 multiple in a normal year. In a good year, it's a 1 multiple. And actually, the gray block there, which is the stake in Harmony Gold, I don't know if you guys have paid attention to the gold price, but at $3,700, $3,750 an ounce in gold, Harmony itself is only on around 6 or so times earnings. So you're paying a 6 multiple for Harmony, and you're paying a between 1 and 4 multiple, call it, for the rest of African Rainbow Minerals' other businesses, which we think is just too cheap. This is the Rand hedge. It's exposed to commodities that are going up, and you wouldn't find these opportunities in many markets around the world, which is why we think South Africa is such an exciting place for us to look. You don't need conditions to be much better than they currently are. All you need is things to be maybe just a little bit less bad, and you could get quite a sharp return in foreign flows. And given the extent to which South African assets are under-owned, the potential upside could be very, very large. These are just 2 examples, but across our funds, we own numerous companies that are exposed to the South African economy that are trading at very low single-digit multiples and very high, almost double-digit dividend yields. This doesn't happen very often. So the 3 funds, as Eugene said, 2 are equity funds. One is an equity-only fund, which is 100% invested in South African equities. You can see that's our SA equity fund. One is a general equity fund, which is 63% invested in South Africa. In terms of Reg 28, can go up to 45% offshore. We're currently sitting at 35.7% of equities outside of South Africa, and those equities mirror what we hold in our global equity fund. And then we also have the balanced fund, which again can invest up to 45% offshore, is currently 56.8% invested in South Africa, of which 36.4% is in equities. And this one has 43%, 43% of this fund is invested overseas. And those are in assets that replicate our global balanced fund. So in a nutshell, we think this is a great opportunity, and I'll maybe close it there. I'm happy to take some questions.
Right, many thanks, Simon. Any questions from the audience for Simon? We won't charge you. You're welcome to us. Right.
There's it.
Simon, on JC Limited,
Yeah.
what factors do you believe will turn that around? Because we've seen years of decline. What do you think can happen that can give a positive impetus to that change?
Yeah, I mean, I think at some point valuations are just so low that in itself starts attracting capital flows from elsewhere in the world. You've seen those flows consistently negative for a number of years, and you're also seeing a lot of markets elsewhere in the world trading at all-time highs. The S&P, for example, trades at a multiple of in the mid to high 20s, and actually markets in Japan, markets in Europe, elsewhere in the world have run really, really hard. So I think at some point, just the fact that it's so under-owned and so neglected, at some point, you get to a point where the last marginal dollar has already left. There is no more capital to leave. And then from there, you can only have sort of one-way traffic. But South African businesses are doing a good job navigating understandably a difficult environment. So we're seeing companies with tremendous management, really dynamic, investor-friendly, paying very high dividend yields. The rand looks like it's strengthening. Commodity prices will provide further support, so a high gold price, high platinum prices. Again, you would think at some point that starts attracting foreign capital, and all those benefits start trickling through to domestic companies. So, listen, I'm not naive about the issues that South Africa faces. We've got family here, we have an office here, we're very close to the conditions on the ground. All you need is for things just to stay kind of the way they are or stable. And we think the upside to valuations are tremendous on South African consumer businesses, on South African banks. Even South African commodity companies haven't fully yet priced in higher platinum, higher gold prices. We find very low multiples across the board. But it is very difficult to identify a catalyst. I guess once that catalyst is there, it's too late because the market will move in anticipation of that catalyst. So once it's obvious, it's the horse is bolted.
Very interesting indeed, because I mean, if you look at the trends in our market, we don't really see international or global fund managers launching funds in SA. And I'm not talking about feeder funds, I'm talking about SA equity funds.
Yeah.
So our market's really definitely exciting, and it's good for us to be able to access your skill set on SA-based funds as well. Very quick question, views on gold. I mean, gold's been a huge tailwind for our terms of trade, for a big part of our markets, for some of the companies you showed. Is this a time to take profits from gold, or what do you think?
I mean, it's very difficult to predict the gold price, but if I look at sort of what's happening at the moment and what may come to pass over the next few years, you're moving into almost a perfect storm for real hard assets, tangible assets, anything that's not cash, with investors losing faith in central banks, in fiat money, not really trusting governments, heightened political risk, several wars happening around the world. We think this is a great tailwind for higher gold prices, but also prices of, I mean, I think part of that is also why markets are high. Part of that is why Bitcoin's high. People are looking at alternatives to cash. So I would not be surprised if gold goes through 4,000 and in time through even $5,000 an ounce. It could certainly happen.
We are recording this, so it's really great for you to give us those numbers. Fantastic. Simon, thank you so much for being here in SA.
Thank you, Gene. Thank you
we
very
are
much.
going to see a lot more of you in the coming years to come. Thank you. Right, we're continuing our discussions on SA equity. Like I said, very interesting for global fund managers to come and launch SA funds. Coming to the stage now from Visio Fund Management, Filelo Machekane from Vigio, you can come through. Thank you very much. If you look at SA equity over the past 12 months ending August, investors roughly got about 26%. And I mean, it echoes through to what Simon said as well. But there's still some headwinds. I mean, and again, Simon mentioned some of those headwinds. There's been some good terms of trade for SA. But if you look at the state of our economy, our GDP growth, if you look at our debt to GDP, and political noise, I mean, how much more can clients expect from SA equity as a whole? Filelo, thank you so much for being here this morning. Great to have you, and the stage is yours.
Thank you very much. Good morning, everyone. And thank you very much for taking out your mornings to come and listen to our story today. I think, as Eugene has introduced me, my name is Filelo Machekane. I've been with Visio for the past 15 years. And I'm basically right now heading up the SA equities for the funds that we manage. And my topic for today is basically navigating the current market volatility. The previous speaker spoke about how the gold price today could be substantially higher, just given what's happening globally. Investors are losing confidence in the markets, in central banks, etc. I think we'll cover a little bit of that later. As an intro, who is Visio? We've got a team of 13 investment professionals covering domestic equities, covering global equities, and also fixed income. Our experience in the market, we've got over 30 years in fixed income, over 27 years in SA domestic equities, and in hedge funds. The firm was started as a hedge fund business back in the day. And we also have offshore experience of about 25 years. When I initially joined, it was to co-manage the Pan-Africa funds. This was 15 years ago. So we've got that alongside the 13 years managing Sharia funds. From exposure point of view, we are quite a well-diversified team, as you can see on the chart on your right. We've got various levels of exposures from a qualifications point of view. It brings with it some positive dynamic in that views are challenged all the time. We've got very different ways of thinking about different ideas. And so as a result, it improves our investment process extensively. So we've identified two key drivers of volatility currently. We've got in the one bucket, global drivers, then in the second bucket, domestic drivers. I think as we've spoken, the domestic environment remains quite challenging. The consumer remains under pressure, businesses remain under pressure. Having said that, what we've seen is that interest rates remain quite elevated. Our inflation rate right now is about 3%. Right? The gap between our prime and inflation rate, our prime lending rate and inflation rate right now is closer to about 7.5%. That's quite big. I mean, we haven't been at this level over the past 5 years. And I think the consensus is that there is significant room for that gap to narrow significantly through rate cuts that come through. We've got reforms that are taking place. And again, consensus is that they're not taking place at a fast enough pace to actually drive more investment, drive more employment into the economy. However, there's a positive backdrop to the SA macro. The recovery and continuing increase in precious metals is quite significant. We've seen it, first of all, taking place in the gold space. And more recently, we've seen PGM prices actually rally quite substantially. What we've seen historically is that whenever we had a big rally in PGM prices, you started seeing it making an impact in the economy, call it 12 to 18 months after. So in our view, call it H1 next year into H2 next year, you will start seeing an improvement in government revenues as a result of better profitability from these companies. In addition to that, better employment by this industry. And lastly, better returns. We don't think the stocks are pricing in the higher metal prices, and we think the recovery will continue. Look at globally, on the other hand, the US inflation rate is the same level as ours at 3%, right? But they're about to cut interest rates despite the rate being above their 2% target. So this is not a great environment for the global macro. In addition to that, you've got the continuing tariff issues. I don't think it's settled. I think it was a day or two yesterday, actually, the US and China met, still trying to resolve their trade negotiations. It has not settled at all. And we still to see what the impact is going to be on the rest of the world from these higher tariffs. The data that came out of China a day ago as well has not been supportive of global growth. Consumer remains weak. Investment numbers went backwards. In addition to that, house prices continue to fall. So it's not a great environment for the Chinese economy either. And as a result, support for broader commodities is likely going to be muted in the short term. Additionally, the previous speaker spoke about the global geopolitics. We've got the issues in the Middle East and in Eastern Europe as well. Those are both supportive of commodity prices, and they've resulted in elevated inflation in some cases, and they'll continue to be disruptive. So the picture that I'd like to take you from here is that the global macro is not great. So it's not good for investing. And if you look at the domestic space, it's not great, but there's some positives that we can take away if we look forward. So these are the two charts I'd like to highlight. I mean, if you look at domestic equities, right, we are sitting on a 10-year basis below our average 14 times PE multiple. So we are cheap, right? Our environment is challenged, but we are cheap. So which informs us that there is limited downside risk that we are facing in the SA market, and there is an opportunity to actually buy into attractively priced companies. On the other hand, if you look at the rest of the world represented by the US, sitting way above the 10-year averages, pretty much recovered through COVID, past the levels that the market was at pre-COVID. So on the other hand, we remain below pre-COVID valuation levels. So we think there's a great opportunity, and we don't know when the catalyst will come, but you can pick great run companies which will give you good returns in the years to come. Because the environment remains quite uncertain, we don't think it's a case of rising tide lifting all boats. So we remain quite selective in the names that we invest in. So the companies that we will buy into our portfolios have to have strong corporate governance, experienced management team. It's been tough. For over a decade, it's been tough. So the companies that have managed to negotiate through all these issues, call it COVID, call it the riots that took place, and the mismanagement of the SA economy, they are very well experienced. And we think they'll continue doing well if the environment remains as is. In addition to that, the companies must have strong free cash flows and strong balance sheets to be able to stand on their own. I'll call out some of the themes that we've identified as representing the companies with our funds. Offshore and global companies, we lack process, and we just think it's a cheap entry into Tencent, which is a Chinese-based company, where we expect earnings to continue growing in excess of 20%, and we think process offers good value from that point of view. We've got gold exposure. We remain constructive on gold. We're sitting at an overweight position there. and I've just highlighted AngloGold Ashanti there, and we think it is the best of breed within the space available to SA investors. We've got special opportunities, which is mainly made up of domestic companies. So these are companies where there could be a value unlock opportunity, or where these companies are actually in a turnaround phase. Turnarounds here, Tiger Brands, I think it's an ongoing phenomenon. They've been losing market share for a number of years, but because of the new management team looking at things differently, they're trying to claw back. They're actually clawing it back, and we've seen it in the share price. We got involved in Tiger Brands, I think it was at about 180 rands, and today it's sitting at about 300 rands. Old Mutual is the most recent entry into our business. I'll talk to the Old Mutual slide later on, but it's underperformed. They've got a new CEO, and it's pretty much aligned with our views that the company has underperformed its peers, and he's trying to right the business. CMH, I think despite the tough environment, new vehicle sales continue to do well. Double-digit growth that we're seeing on a month-on-month basis, and CMH is well placed there. It's a fourth car dealership business, and third in rental, and we think they've got nice exposure from Chinese vehicles, which are taking market share from the incumbent European and American vehicle manufacturers. As a result, we see great opportunities there. On the property side, we've got Fairvest. If you look at the past, call it 15 years, I mean, property has done quite poorly. What attracts us to Fairvest is that they've got some of the best retail assets that you're going to find in the country. These assets are in peri-urban areas, in townships, and rural communities. There's very limited competition in those spaces. Whenever space is available, it's taken up quickly. And we think, as a result, they'll continue to outperform the rest of the sector. Napier Rockcastle, it's an Eastern European operator, also high growth region, and Napier also has some of the best retail properties that you can find, and it gives you an 8%, plus 8% yield in euros. Domestic champions, I've got Northern there. We're quite constructive on the PTA space as well, and we've got Momentum. We've been involved with Momentum since 2022, and since we started engaging with the company, we've managed to generate returns in excess of 150%. I think it is the same process that we are looking to follow through in our investment in Old Mutual. Pretty much it's the same thing that has happened there, where the new management team came into place, and they started identifying opportunities where they could drive better efficiencies out of the business. MTN, I spoke earlier on that when I joined Visio, it was to look at the Pan-African market, and we've turned more positive on Nigeria and on the Ghana operations. We think over the next at least year or two, those businesses will continue adding quite considerably to MTN's growth from an earnings point of view. And also, versus where we were, the company couldn't take out cash out of their Nigerian operations. So that situation has changed quite dramatically, and now their balance sheet will be in a much healthier position. I spoke about our engagement with Momentum in 2022. So where we see that there's an opportunity for a company to actually unlock value for shareholders to better run its business, not that we are experts in insurance, but where we'll compare the company to its peers within the industry. And where we see something lacking, we'll engage the management team, we'll engage the board as well, on where we believe the opportunities are to actually right the business. So we embarked on that same journey with Momentum, and we've just started with Old Mutual, and we think that over a period of time, it will start yielding results. think what's quite nice is that Momentum has been engaging in buybacks for the past, call it 3 years, right? Old Mutual has now just entered the party. They've released their results last week, and there they announced that they'll be undertaking a 3 billion rand share buyback, which we expect to last for about a year. So these are cash-rich companies. They generate good returns, and the best deployment of capital when your stock is cheap is to buy back your own shares. So going back to Old Mutual again, I think this is what I was speaking about earlier on. Over the past 10 years, from a sector point of view, you've got Sanlam, which has done just under 115% total return over the past 10 years. But as you can see, most of these companies, the returns have come through over the past 3 years. And you've got Momentum, where we've been invested. It's done 95% over the past 10 years. Discovery followed just under 90%. Old Mutual, on the other hand, a clear laggard here. And it's lagged for a very good reason. It's not been performing at the same level operationally. It's done just under 25%. So we think it's just cheap versus the sector. It is underperformed from a share price point of view. There is low-hanging fruit, and we think it will recover quite nicely. Like I said, we're constructive on PGMs. We've had Sibanye-Stillwater and Anglo Gold Platinum saying production will be down 5% of global supply. That's supportive of PGM prices, and we think we'll continue having a nice rally there. If you look at last year, these companies, last year this time, these companies, with the exception of Northam, had negative free cash flows. Now we've got positive free cash flows, and none of them are willing to actually waste that money in new capex, and we think it's quite positive. So I won't go into gold, but just highlighting this chart over here. This shows from a reserves point of view, global central banks are still very low from a reserve point of view versus where they have been historically. Your developed central banks, developed economy central banks are sitting at over 60% gold exposure, whilst developing Russia, China, Brazil, they're all sitting at less than 20%. So there's still scope for big, significant increases in purchases over the next few years. I think this is just a quick summary. We're expecting a recovery in SA. It's delayed, but we think we should gain momentum next year. Globally, things are tough, and SA offers a nice investment opportunity given that valuations remain low. I think this is just a slide that our funds over the past few periods are either first or third or second quartile. And that's it. Thank you very much.
Lilo, thank you very much. Just want to check questions from the audience. Right, no hands. One question from me very quickly. You're also obviously positive on SA Equity. You've got your own SA Equity fund. But just quickly to test your asset allocation views, you've got the Actino fund, which is a multi-asset high equity. In that fund, what's your positions on SA? Are you overweight SA, and are you then overweighting SA in favor of global, or where are you?
We are overweight SA. I mean, our preference for SA stems from a valuation point of view. I think there's great opportunities in SA versus the rest of the world, as you've seen in the previous slide. And should the environment become tougher, we think there's limited downside. I think one of the key things in our investment process is that we will protect capital at all times, just because of our hedge fund roots.
Thank you very much for that. Anybody
Thank you.
else? No, that's it. Lilo, thank you for your time this morning. Right, and I have to do this because it's too easy. At the ready is Chris Reddy from All Weather Capital. Chris, thank you so much for being here this morning. And like I said, it's too easy. I'm so sorry. Always great to have you here, Chris. And looking forward to your presentation. It's up already. Thank you.
Thank you.
Clicker is here.
Click is here. Perfect.
Yeah.
Got it. Awesome. Okay, perfect. Good morning, all. I hope you can hear me. As Eugene said, when I saw him this morning, he asked me, if I was ready for the presentation. I was going to respond and say I was born ready, but it was a bit too corny to start the morning on that note. So as he said, Chris Reddy, I'm a portfolio manager and head of trading at All Weather. The good thing about not being first off on these presentations is all the good stuff is presented by the guys previously. So hopefully I can just give you the highlights reel in terms of some of the things that we're seeing in the market and how we're looking at investing. If I can just leave one slide with you, I think this is the exact summary in terms of the key things that I'm going to be discussing with you today. So in summary, we think that there are good reasons to be positive around globally emerging markets. I think international investors were shocked to see the true extent of the tariffs that came through in April of this year, and many are now looking at ways of actually protecting clients' wealth and looking at diversifying away from the US markets. We think that this 15-year bull run in the US is coming to an end, and investors are now looking away from diversifying from these Mag 7, NASDAQ, S&P, and the likes. South Africa has had an exceptional start to the year. We'll unpack why we think that that's potentially going to continue from these levels and hopefully start spilling into other sectors of our economy and our stock markets. One of the benefits of if we do see EM inflows, that will also filter through into South Africa because South Africa is about 3% of the MSCI EM index. We think there are good reasons as well to be positive our domestic shares. Yes, it doesn't seem that apparent when you look at the performance of our domestic shares being retailers, insurance, and banks year to date. But I'll unpack why we think that the performance has lagged some of our commodities and other rand hedges year to date. And then we'll touch some of our stock picks as well. One of them actually being JSE as well, so I'm happy Simon actually touched on that in his presentation. So quickly before we go into that detail, I think one of the processes that we have implemented over the past couple of years is also incorporating macro into our investment process. Yes, we are fundamentally bottom-up stock pickers, but I think in this environment where there's a lot of volatility, as Pagelo has already mentioned, you need to be cognizant of what's actually happening from a macro point of view. If you take this year as a case in point, a lot of the resources run that we've seen, whether in gold or in PGMs, has also been a factor of both the geopolitical risk, which is linked also to this weaker dollar, Trump's policies around the Fed and the likes. If you didn't have that view around a weaker dollar outlook, you probably would have missed this resources rally in our precious metal shares. Coupled with the macro geopolitical overview, we also are very cognizant of investment flows in our market as well. So as Simon mentioned around the illiquid nature of the JSE, when large managers are trading in our market, they will have an outsized impact, whether they're buying or selling. We use that to our advantage because if they move it away from what we think is a fair value for the company, we will take the opposite side of those trades, and it just requires a bit of patience to wait for that to actually play out in our markets. In terms of the two ideas that I want to discuss as well, we've launched a global emerging markets fund in 2018, so we're running about 6-year track record. We're in the process of also launching a SA feeder fund rand denominated through BCI and Eugene and the team. We think that it is an attractive asset class, especially given our view around flows starting to move away from the US into gems. That's where the growth is going to be coming for the foreseeable future. And we are overweight China in that fund. Year-to-date performance has also been very good. We're running at about 6% ahead of the USD benchmark in that fund. We also launched a Best Ideas equity fund. As a house, we were previously a benchmark cognizant house. A lot of clients came to us and said they were looking for a more concentrated, actively managed fund, and that's why we launched the Best Ideas fund. It takes our best ideas from our hedge fund and our long-only product, typically runs between, say, 15 to 20 ideas, but high concentration bets. So to an extent, similar to what Simon was talking about, where you've got quite a high tracking error, big bets per position to really go for that alpha generation over time. Again, good performance since launch. We're running at about 33% over the past 12 months in that product. Okay, so just recapping in terms of those key themes that I discussed earlier, why we think EM, the time for EM is now. As I mentioned, April was a shock to many in the financial markets. You saw what happened with bonds, you saw what happened with the dollar. There was basically no place to hide if you were running a balanced fund. The dollar was weaker, US treasuries were also weaker, so the safe haven plays did not do as expected. Your balanced funds also actually lost capital in this period, and you saw a flight to safety with gold, even the likes of Bitcoin running as well in April. we think that the world is moving from unipolar to multipolar. And what we mean by that as well is that previously, if you're an SA investor, 4 things were constant in your life: debt, taxes, a rand depreciating, and investing in the US market was going to earn returns for your clients. Those conditions, 2 of those conditions no longer are relevant. Debt and taxes still around. But we think that as investors start tilting their portfolios more towards EM markets, South Africa will be a net beneficiary of that, and you can see it in the chart that I'm showing you over there. So the 3 lines there, MSCI SA, these are all dollars. MSCI SA has actually been the best performing market, has actually outperformed the MSCI EM index and also outperformed your S&P and NASDAQ. Now, yes, we know a large chunk of that has been driven by the resources rally. I'll unpack that as well. But we think if you expect the dollar to continue to remain weaker, given Trump's policies with the Fed, we just think that gold continues to run from these levels. We touched all-time highs this morning, $3,690 an ounce. That will also start filtering through into platinum as well, because obviously dollar-denominated commodities. We think that China still has good growth ahead of it. And also, if you look at how China compares to, say, the Mag 7s, it still trades at a deep discount for similar equivalent type of AI exposure. And that can also be seen with regards to how well the likes of Tencent and Alibaba have performed. Behind that as well is also a very supportive domestic economy, with Chinese investors sitting on almost $23 trillion worth of cash. So as they've been moving that into the equity market, that's been the major driver of those markets, and they're not actually reliant on foreign flows for now to drive those markets. The final point is that global managers are also underweight EM. So as you get this wall of money, should they join this party, there's going to be a wall of money leaving the US and starting to go into gems, which will also then potentially support those asset prices. I won't spend too much time on this chart, but basically what it says is it's a quote from Rich Newsom from Mercer. So he's a global asset consultant, and they were just highlighting the point around what happened around April, where asset consultants had basically no place to hide at the start of the US tariffs, and they were all now re-looking at their long dollar, long US positions to see how can they actually protect capital going forward, and what does it actually mean for diversification for their clients' funds. I'm sure SA advisors are also asking the same question, because that has been the go-to trade for many advisors, and they're now looking at other opportunities. Quick slide to just talk about from a valuation point of view. So you can see what I'm talking about, that 15-year bull market in US equities. This is just US S&P 500 over the emerging markets index, and you can see it's been a straight line down for EM versus the S&P 500, so the trade has done very well. The blip that we've seen at the bottom there just shows you the true extent of what is possible should we start seeing these EM flows coming through. Similarly, at the bottom as well, the dollar has been the go-to from a currency perspective. I think the Russia-Ukraine crisis, as well as what Trump is doing now with the Fed, potentially puts that into question. And we also know that he's basically forcing the BRICS countries to start engaging more actively with one another to potentially look at reducing the dollar's dominance as a global currency, with them potentially looking at a BRICS currency, and also now moving more and more towards commodities, gold in particular, as their store of value instead of US treasuries. Quick slide around what I talk about by fiscal dominance. This is our key concern that we've got with the US. So in the past, it was a monetary dominance economy where the Fed was independent and there was a clear focus around inflation. As you can see right now, for the past couple of years, the Fed has actually missed their targets around their 2% inflation targets. And there's a lot of pressure coming through around that board with regards to bringing through cuts. We do think that we probably see a 25 basis points tomorrow. If it's more, I think you're going to see a bit more pressure around that dollar, and also more pressure on bond yields in the US, which again is going to filter or put more fire into that commodities support, so gold and PGMs in particular. So we're slowly moving more and more towards this debt crisis as the US continues to borrow to fund that economy. A couple of slides in terms of just what does the landscape look like. So the US currently is about 27% of global GDP, but it accounts for 64% of the MSCI World market cap. 64% of MSCI World market cap, whereas the top 5 EMs account for 25% of the global GDP, but they only account for 88% of the global market cap in the MSCI world. So massive disparity around just the relative positions over there. If you look at China, so this just highlights the chart I was talking about, where you look at China Internet trading at roughly about a 15% forward versus the Mag 7s that are more than double that at a 30% forward. And what you've seen of late is that the go-to shares in the likes of NVIDIA haven't actually been providing that blowout earnings or analyst surprises at the recent results, which talks to potentially them being quite toppish at these levels. Amazon is our number one share that we hold in the fund from a valuation point of view, from an AI exposure point of view, as well as just generally operating performance cash flows that they're generating as well. So you can see with the recent results that they've had, bless you, Amazon is currently trading at about, I think it's about 150 Hong Kong dollars. We started the year at about, it's just over 100. So you can see that Chinese support coming through to actually buy the share and support the share. The image on the right-hand side is what I do when I'm bored in the evening. If you can't see the images there, what I'm showing you is for each of the various sectors in the Chinese economy, whether it's automotives, semiconductors, consumer brands, and digital services, what we've seen over the past couple of years is a consistent trend of Chinese supporting Chinese companies. So there's been a move away from buying from the Western or developed market companies and supporting the locals. And that can be seen with regards to the sales that global companies are having in China. So if you look at, say, Tesla or Porsche, I mean, Porsche at some stage, China was probably about 30% of their global sales. It's now probably mid-teens, if that. And the locals for the likes of BYD, Xiaomi, which basically makes the equivalent of a Porsche for $35,000, has been eating up a lot of that market share for the Western companies in China. Similarly, if you look at the semiconductors, Cambricon, if you do yourself a favor, look at the chart of Cambricon. It's basically going vertical and makes gold look quite tame in comparison. But they basically make a semiconductor chip as well to compete with the likes of NVIDIA in China. Even in SA, you're seeing a similar dynamic with regards to the amount of Chinese vehicles on our road. I mean, there are some forecasts of them potentially getting up to about a 30% market share over time. And it's quite clear if you look at just the value on offer. I mean, even if you were to throw away the Chinese vehicle, you're still going to lose less money on that trade versus the depreciation on some of your German brands. And you're still getting 1 million kilometer warranties and the likes. So that's the trend that's happening in China. We think it's going to start happening in SA as well, especially on the auto side. Quickly recapping around China, you can see at the point I mentioned around the $23 trillion worth of cash. That money is now going into the stock market, and that's actually driving that investment boom that we're seeing in China. I won't touch on too much around that, but I mean, just in terms of the basics around asset allocation, so this is some work that Goldman Sachs did around what is the optimal allocation to emerging markets. And based on their analysis, they target, or they say that based on an efficient frontier, you should have between 20 to 30% of your portfolio in EM. Investors are sitting at single digits at the moment. So there's still quite a bit of money to flow into that trade. I know I'm running out of time here, but I want to just discuss this one slide in particular. So when anybody looks at the JSE, it's been a phenomenal year on our market. This is a graph that we put together that basically unpacked what have been the drivers in the JSE year to date. And you can see this is probably till the end of July, early August. 10 shares have accounted for 95% of the return on our index, the bulk of them being resources, and then a splattering of rand hedges being Naspers Process, and you've got some BCI and MTN, which was driven off the back of the strong Ghana and Nigeria numbers. So while this looks great from a returns perspective, what this unfortunately does for the rest of the market is that it does pressure a lot of the domestic sectors. Because what we've seen in our market is going into 2025, many of the large domestic managers that drove the rally post-GNU were overweight the domestic sector. So they were buying our retailers, buying our banks, and buying our insurers. They came into 2025 with those overweights. They were underweight resources. So when we had this rally in the precious metal shares, the only way to fund those underweights or close those underweights were to sell down the domestic shares. And that's part of the reason why the likes of our retailers, banks, and insurers have actually struggled year to date as local money switched into chasing this resources rally. We do think that many of the managers are now at weight or getting closer to at weight on these precious metal shares, given the various placements that have happened, Valterra in particular. And we are hoping that once these retailers start producing results, you're going to start seeing this operating performance coming through strongly that supports the valuation that we're seeing it. And of late, you can see, for example, First Rand, OUTsurance had excellent results yesterday. We're waiting to see what happens with Pepco as well once they report in November. But you're going to see this dislocation between the good quality companies that are strong management teams that are performing well versus those that were just lifted with the tide with the GNU flows from last year. Won't spend too much time on this, but I know I'm over time already. But just to recap in terms of one of our top picks in the portfolio, this is Pepco. Why we like this share is that they've got market-leading performance in the value category, which, as you know, if you look at the RLC data, it's been one of the more defensive plays in our market. What the market is not appreciating, I think, is just the value or the growth that's potentially going to come through from their fintech business that's being Flash, as well as their credit offering as well through Connect. I think the dynamic around Pepco of why it's underperformed is you had the IBEX placement, and a chunk of the IBEX placement went to creditors. And what we've seen in the market is that once the creditors got those shares, they started selling that into the market post the placement. So you've had this two-stage overhang into our market. But we think Pepco at just over a 13 times multiple, it's about 0.5 times more than Mr. Price, is probably the most attractive consumer play that we've got at the moment. Management are aligned with shareholders. I mean, Peter Erasmus basically bought just over 1.5 billion rand worth of shares as of last month at 27 rand. So we think going forward, this is the one to hold now that the overhang risk has been removed and the company can actually just perform on its own without the IBEX/Steinhoff thing around its neck. And then just to recap in terms of the performance, as I mentioned as well, this is our best ideas performance since launch. Eugene, I think that's me. If there's any questions.
Many thanks, Chris. I just want to check quickly questions from the audience. The clock caught us a little bit, Chris. I know you're sticking around for tea time. So if any of our audience members, if you want to engage with Chris, more than welcome. Chris, thank you so much for being here this morning.
Cheers. Bye.
Investment management. I'm always looked at stranger to get that right. Clive Stokey-Steak. Stoich's-Steak. Did I get it right? Fantastic. Clive, thank you so much for being here. We've seen your colleagues frequently at all our investment seminars. Great to have you with us here this morning as well, and thank you so much for joining us. And the floor is yours.
Thank you. Good morning. Good morning, everyone. This classic 1966 spaghetti western launched Clint Eastwood's international fame as an actor. Spaghetti westerns were inspired by American westerns. They were low-budget Italian-made movies that were mainly filmed in Spain and Italy. Let me just get the clicker. Apologies. They were also known for, what they were known for was their gritty style and morally ambiguous characters and also violence, aspects all too familiar to us in South Africa. Before I touch on some of the detail, just to point out, Investec Investment Management has always been guided by investment philosophy, which has been shaped by our private client heritage. We have a deep understanding of our clients' needs, concerns, and also emotions around investing. And we have seen how equities have been a very powerful source in wealth creation over time. We achieve this by investing in growing quality companies that can compound wealth over time, and that stood us in good stead through various cycles. So we don't try and time the market too much. We try and find very good shares that we like or companies, and we generally stick to them. The South African economy has been hamstrung by various constraints, but we have a couple of positive things happening for us at the moment. The South African assets have outperformed global assets, like some of the speakers previously had said, and that's for a variety of good reasons. Government borrowing has become a bit cheaper. The rising gold and platinum prices have certainly boosted earnings and also tax revenues. We've seen Chinese stimulus support global exporters, or at least the commodity export companies, and also a revival in Europeans' industrial activity, which does benefit our exports. Additionally, a weaker dollar, which is what we've been experiencing this year, is positive for South African assets. Our inflation is well contained, and I think at the formal income level, things are still, in pretty good shape. And our equities are very cheap. We trade at a big discount to international peers, and we're delivering return on equity way ahead. What's not working, though, is that our economy is growing at snail's pace. The Reserve Bank has been very reluctant or cautious to cut rates. And, in addition, we've seen US tariffs. That's added to global uncertainty. We've also seen that the volatility in the market is a risk for South African assets. The slowdown in the US certainly could harm global growth, and persistent US fiscal risks are also a concern. What is ugly, though, is the structural reform progress that has stalled. We see that the performance has been weaker from the state-owned enterprises. Business confidence is falling. The formal sector is shedding jobs, and we've got way too low capital investment to truly reach our potential from a growth perspective. Our portfolio, however, is positioned in quality financials to try and navigate some of these challenges, also undervalued retailers and some global stocks exposed to some of that global growth. We are selective on platinum and gold, and also on some of the diversified miners. The performance of the JSE Precious Metals Index relative to the index has been volatile. It's rallied about 8 times in the last 6 years. And the performance, year to date this year has been remarkable. We've had, certainly, it depends on which index you're looking at, anything between 80 or 90% of the top 10 shares that have come from either a gold or a platinum company. The platinum group metals index is up about 40%, and also the gold. Yet we've seen gold more than double, and also platinum broadly double. The size of the precious metal sector on the JSE has also grown significantly, with both platinum and gold contributing to that growth over time. Just this year, gold has gone from 7% of the index to about 15%. Platinum's gone from 3 to 6. These are extraordinarily large numbers for a very volatile sector. The price of gold relative to copper is the highest it's been in the last 35 years. Sort of levels that one previously had at times that occurred during US recessions. The traditional drivers of gold, in higher inflation, the weaker dollar, and also central bank buying have all contributed to this in terms of the increase in the price. But what's given it impetus is, in actual fact, what we see is massive investment buying from the ETF market, and also the Indian imports are at record levels. Can this continue? We actually think all these are in place. They're still in place, all these drivers. We do think there's probably, from a long-term perspective, more or better value in copper than in gold, but at the moment we certainly are enjoying this run. It's also interesting to note that looking at the performance of the financials on the JSE, it's diverged from the broader index. Financials are up around 4% at the index level over the last year, and the market's up 26%. Historically, financials did a little bit better than the broader market over the medium to long term. We expect that in time, we think there's a lot of value in our financials. So we expect that correlation, or at least that type of performance, to show itself in the market over time. And we're patient. I mean, we long-term investors, we do not, if a stock underperforms for a while, we're very happy to hold it through the cycles as long as we're happy with the fundamentals. So how are we positioned to try and navigate, the good, the sad, and the indefensible of South Africa? Well, as long-term investors, as I said, we favor quality. Thank you.
Clive, thank you very much. Questions for Clive? That was very brief. To the point.
Sorry, you've...
I just want to check quickly, because we've had a lot of exposure to your funds and your business, but maybe just a little bit more background in terms of your stock selection process. You've got a SA equity fund, which is dynamic equity.
Yes.
You've got the general equity fund. But how does the process work? Because, I mean, we getting to know your firm, but maybe just position that in relative to other businesses, because, I mean, we're all spoiled for choice in the market. Why do we place money with Investec?
Yes. So in the main, the core of our equity fund is committee-driven. There where the committees make that decision. But then we do have some pragmatism, or at least flair, that certain portfolio managers might, showcase, certainly like in the dynamic equity side. There, Barry Shamley and Peter Vogel, they have the ability to participate certainly in the mid-small cap sectors, whereas in the main, for the main equity portfolio, we are constrained there with liquidity. So your large caps, high quality companies, there we have a group of analysts, but it's a top-down and bottom-up driven process. But the liquidity constraints around the medium and small cap stocks prohibit us from buying that in the fund.
If you had more exposure to mid-caps and less to resources, I mean, we all know by now, then you've lagged the market. How do you manage that in a portfolio? Do you then try to play catch-up, or do you maintain positions?
Well, it depends. If the fundamentals are still in play, we certainly maintain positions. We've ridden out positions for a very long time. Our clients are not short-term focused. They are long-term focused. As I say, the average investment horizon for a private client could be anything from 20 to 50 to even longer. So we're pretty happy to ride that out. And if there is some fundamentals that have changed, we might participate. But we are, in the main, if the fundamentals have changed, we will change, which is not capitulation, but it's more fundamentally driven.
There was a question this morning to Simon in terms of, is there a catalyst in the SA market to get some of these positions, some of these companies doing better or not? Rates, a lot of discussions on rates this week. I mean, it's going to be a very busy week. Fed coming out tomorrow. Cyprus also going to make a decision. Do you think that if we see more rate cuts in September and possibly another one before the end of the year, does that impact on some of the positions or some of the smaller mid-cap type companies?
Are you talking about South Africa?
Yeah.
Yeah. So certainly we think it will boost it. So, we think it's been an area where we were hoping to see a lot more interest rate cuts as a catalyst for the South African market. But we've seen a very cautious Reserve Bank, and also with the meddling or the potential change in that inflation target, that's also stymied some of that. I think the small and mid-cap stocks certainly would do better with a bit of an impetus from lower interest rates. And we think they'll really do well with structural changes. I think we've got to the point in the market now where we need some, economic policy changes. The way we think about growth in the country needs to change. The way country's governed needs to change. So there's some serious structural challenges that we have. And I think in the main, the market is looking for certainly some evidence of those structural policy shifts. So that's when they'll really do well. We'll have a bit of an impetus from the mid-small cap stocks. But what we've seen is that literally the management teams have generally not been given any love in this market because the mid-small cap stocks have lagged so much that a lot of them, either there's trade buyers seeing value in it and they get taken out. So over the last sort of 5 years and even longer, we've seen various companies being taken out, which is quite unfortunate. But so we think we'll need to see those structural changes more than just lower interest rates.
Also, Ramaphosa saying as well that they need to take some lessons in how to run things. But let's see, change is on the way, hopefully. Clive, thank you so much for being here with us this morning. We really appreciate it. Thank you. Right, next we've got Zanile from 361 Asset Management. Zanile, if you can come to the front, thank you so much. Zanile, thank you. I think the clicker is there. Yeah, thanks.
Good morning, everyone. Just checking if you're all still awake. The last speaker slot before, on SA Equity. My name is Zandi. I'm from 361 Asset Management. So one thing I like to do whenever I come to do a presentation is kind of eavesdrop, outside when everyone's having coffee, because I love to hear the different pronunciations of our name. So sometimes it's 361. My personal favorite is 360 ne. But it is actually 361. It's just to get that out of the way. So who are we? I think most of you are quite familiar with our firm. But for those who aren't or might want a bit of a refresher, we've been around for about 20 years now. We're owner-managed. Our team has had very limited turnover over that period. So you've had the same people who produced our track record still managing money today. We're style agnostic. And what that means is we don't like to label ourselves as value managers or growth guys. We think that markets go through different cycles, some shorter than others, and you need to be prepared as a manager to be flexible and adjust according to different market conditions. So hedge fund thinking, we started out as hedge fund managers. And what we think hedge fund thinking means is, challenging conventional wisdom and focusing on risk management. Now, despite being around for 20 years, we are still quite a small boutique. Our AUM is around 60 billion rand. So that means we're still really flexible, we're nimble in the market, and we can own some of these smaller companies that we've been talking about this morning. And lastly, we offer quite a diverse range of products. Hedge funds, like I mentioned, unit trusts, multi-asset, because we think that each of these products has its place in a client's portfolio, and so we'll never advocate for one over the other. But when it comes to SA Equity, when people ask us what we think sets us apart, what is our differentiation as 361, we think that really is the ability to deliver consistent outperformance on a risk-adjusted basis. So those are a lot of, words, but what it really means are the graph that you're seeing on the slide right now. So what that shows is the results of an Alexander Forbes Manager Watch survey, which took 44 benchmark cognizant managers and measured them according to the classic finance relationship, risk and return. And in that survey at the end of June this year, we're quite humbled to see that we came out first in that survey. And what that means is that we're able to deliver exceptional returns for our clients with less risk in our SA Equity Fund. So how do we do that? Well, that's the outcome. And it really is the result of two main ingredients of our process. Firstly, we are active managers. We're very active. And as you can see there, if you look at our key portfolio metrics, we've managed to consistently outperform the benchmark. So if you look over a 5-year period, in 60 months, we outperformed in 73% of those months. It's not a bad grade. I haven't had to have grades in a while, but I think that's pretty decent. And people normally think that means that you're also quite, aggressive, risk-taking hedge fund managers. But the truth is, the second ingredient that we think is really important in our process is capital preservation and a focus on always protecting our clients' capital. And the example we've given here is in 2020, when the market was pretty much flat, our funds were still able to outperform. And that's that risk management hedge fund approach, always protecting capital on the downside, but being very active managers. And it's a result that we've been able to have across those different mandates. So whether it's SA Equity, our flexible fund, or the PPS Managed Fund, which we do manage on behalf of PPS, you can see that over these different time periods, our performance, the red bars, has been above the respective benchmark, the blue bar, resulting in that consistent outperformance over time, represented by the gray. So now let's talk markets. Looking back, it hasn't been a boring year at all. In fact, we all know bull markets, bear markets. 2025 has been what we call a bit of a kangaroo market. So, instead of very explicit rising prices or falling prices, we've had a great level of unpredictability, volatility. There's a lot of geopolitical pressure that's happened in the market, and a lot of instability, having us question the dollar as a reserve asset, having us question safe havens, the US Treasury market. Is that still the best way to protect your capital? And all of these questions have led to this very concentrated outperformance in the JSE because of our exposure to precious metals. So a lot of the previous speakers have already spoken about this, and Chris Reddy, Mr. Reddy, very important, remember his surname, from All Weather, presented the same information. That if you look at the top 10 share, if you look at the JSE up to the beginning of August, 10 shares drove 94% of the Aussies' returns. It's quite a staggering statistic. But it does show something that we think is really important. That whether it's a bull market, bear market, or a kangaroo market, there are always places where you can find value. So we've responded to this kind of environment by really playing to our strengths. So firstly, I mentioned that we like to be active managers, and we like to stay nimble. So the example I've shown with that is a specific share, Anheuser. So if you look at Anheuser's share price year to date, which is the red line, you can see that in the beginning of the year, the share performed really well, had a very strong result. And now we're sitting at it probably being up about 9% year to date. Doesn't sound like a very sexy return. It's not one of those top 10 shares, but it's actually been one of our biggest contributors when it comes to our outperformance. And that's because when the facts change, we change our mind. So what those gray bars are showing are our holding of Anheuser, our relative overweight. So coming into the year, everyone held SA Inc., Rand hedges were just, completely dismissed. And we increased our overweight during that time when the valuation was very attractive. Then you started to see the share price running up quite a bit into their results, and we made sure that we lowered our position because the valuation didn't look as attractive anymore. So that kind of speaks to our process. It's not just about looking at a share's value and seeing that you have to buy and hold. In a kangaroo market, you have to make sure that you're nimble, you're flexible, and you're responding to changing information. So that approach has really been a key factor to our performance this year. And secondly, part of protecting capital is avoiding what we call landmines. As hedge fund managers, we do quite deep, thorough research on companies where we don't think there's a lot of value. And we were quite fortunate this year to have missed some of those landmines in the market. We've shown a company like Aspen here, which isn't a terrible business. It's not a zero. There definitely is value there, but the market's expectations just didn't match the true value of the company. And lastly, strong stock picking. We have a team of dedicated analysts that look at each of the different sectors, and this year we've had some pretty good picks that have played on some of the themes we've been chatting about this morning. the Chinese market doing really well. Naspers and Prosus have been a huge overweight for us. And we were given a gift in January when there was some volatility and you could just pick up those shares at a really attractive valuation. Our gold pick has been Anglo Gold Ashanti. We've just preferred the higher quality play in that sector. And then a couple of other names that have worked out pretty well for us. Okay, that's what we've done, sitting in September, spring, new beginnings. What about the rest of the year? How are we actually going to make money and make sure we can keep up that, nice performance that I showed you earlier? Like I said, we think that despite market conditions, there's always something interesting happening. So there are a couple of themes that we've been watching. Now, precious is the big elephant in the room. We cannot talk about the SA market anymore without talking about precious metals. In the previous presentation from Investec, we saw that PGMs and gold now account for about 21% of the index. So as active managers, we have to take a view. What we've seen with gold is the Chinese central bank has, toned down their buying a bit as the price has risen. But the reality is you still have so many macro themes that are supporting that demand for gold as a safe haven asset. So right now, we do have a slight underweight in our funds. We think that a lot of the easy money has been made, and we're still, reflecting our gold. I guess we do still like gold, but we're holding on to the Anglo Gold Ashanti. And on the other side of the curve, we've also picked up some Harmony after the recent sell-off, where the share just became way too cheap. Even though it's not a good quality business, we think that in the short term, you can probably still realize some value because the market really overreacted to the last results. PGMs, I think everyone has already spoken about their view here. We like the sector. The recent placing of Valterra gave us a really great entry point into the sector. So that's one of our significant holdings now when it comes to PGMs. And we also like Northam, which is the other quality play in the sector. Now, another theme that was touched on in the Visio presentation is rest of Africa. I think if we had to go over, the last 10 years or so, whenever an SA company was expanding across the continent, we kind of gritted our teeth, closed our eyes, and just pushed the sell button. Because SA companies have not done well outside of our borders. The tide is turning. This weaker US dollar has really supported a lot of these countries. It's helped them clean up their fiscal positions, but we've also seen a lot of reforms coming through. I mean, with Nigeria, you've got a regulator actually allowing price increases. So now you've seen this rest of Africa exposure no longer being a detractor from performance, but actually contributing to earnings growth. So it's been an MTN story, but even outside of that, if we look at our banks, Standard Bank has a significant presence across the continent, and our research has shown that SA banks are taking share in a lot of these countries. They're competing against some huge global banks and some local banks and are actually doing really well. So there's Standard Bank, but there's also ABSA, which people don't really think about with the rest of Africa. But after the Barclays deal, they have a really great footprint, and now a CEO who's coming from Standard Bank has seen the playbook and knows how to take advantage of that presence. When we were thinking about what to present today, we kind of assumed that it would be the typical, negative sentiment about SA. And so as a team, we wanted to make sure we also highlight the good stuff that's happening. Now, as managers, we understand that everyone was probably too euphoric last year, post-GNU. We kind of put the cart before the horse in thinking that everything would now be amazing and all these reforms would come through. The lesson learned is that these things take time. And we are seeing really positive progress, and we wanted to mention Transnet. The reform agenda has now moved on to rail. We know that the government doesn't have the resources to invest in the required infrastructure, so the private sector needs to participate. And so we have exposure to Grindrod, which will be a major beneficiary of the turnaround at Transnet. And secondly, if you look at SA, we are an emerging market. So a lot of the time, you don't need us to, shoot the lights out, have a maverick president like in Argentina who's completely going to change things. You just need stability. And this year, we're being helped in the stability department. With precious doing well, with lower oil prices, a stronger currency, our terms of trade are looking okay. So the fiscal picture isn't that bad. And all of this supports a stable environment. And of course, SA Inc. is still cheap. You know, our bonds have done really well, our currency has done well, and when we speak to different emerging market managers, that's what they're attracted to in SA. They haven't had time to look at our equities yet. But we think right now you're in this really great position where you have good businesses, especially in the banking sector. The example I'll use is ABSA. It's trading at a 6.5 times PE with an 8.5% dividend yield. And there are a lot of positive catalysts if you're looking 12 months out. I mentioned the new CEO. And what that means is you're getting paid a dividend. So you're literally getting paid to wait while the company sorts out all of its issues. So even if, you know, the new CEO doesn't live up to these expectations that I've outlined today, it's still a very decent entry point, and you'll still get some return on your investment at these prices. And those are the kind of SA names that we're liking right now. And looking at our broader positioning, I mentioned ABSA already. I don't know if it was clear yet, but one of our top overweight positions. We think that the bank is going through a bit of a turnaround, but once again, you have that high dividend yield that's making sure you're paid to wait. We like Glencore, ARM, Naspers Process, companies that have already been mentioned this morning, and we still really like Grindrod. We think it's well positioned. When it comes to our underweights, I always say to clients, don't read too much into that. It doesn't mean that we think those are terrible businesses. In fact, those are some of the best businesses on the JSE. We just don't think the valuations are attractive right now. And we see better opportunities for better returns in the market. So that's who we are as 361. That's what we like right now. We think that there are still opportunities in the rest of the year to make money locally. And just like everyone else said this morning, SA is cheap. And they are really good companies. And most importantly, in a lot of these, we're currently being paid to wait. So thank you very much for your time.
Zandile, thank you so much.
Thanks,
Very
Eugene.
quick question from my side. Very few have actually spoken about that, but you've touched on it briefly. The dollar weakening at the moment, the rand gained. How does that impact on rand hedge stocks in a portfolio, and how does that come into your thinking?
So this is the beauty of our process. We're fundamental investors, but we also apply a macro overlay. So one would think, in a year where the dollar's been weakening, you would want absolutely zero rand hedge. But as you saw in another slide, 3 rand hedges have been major contributors. So Anheuser, British American Tobacco, and Naspers Process. And that just speaks to the underlying fundamentals of those businesses, getting in at the right entry point. They weren't macro calls. Instead, it was specific companies that were doing quite well. And then the big way that I think that those currency dynamics you mentioned do impact positioning is with resources, where you wouldn't want to be underweight in that kind of environment.
We've seen the active management in your portfolios for many, many years now, so thank you very much. Just want to check, any questions from the audience?
Hi.
Right. Yes?
Thanks. As an active, how has your philosophy changed over the last 10 years? That's the first question. The second question is, how quickly are you able, let's say you get it wrong, how quickly are you able to change, especially with our volatile political, economical environment?
Great. So with the first one, how philosophy has changed, the market has become a lot more concentrated and smaller too. And so I'd say probably 10 years ago, we weren't benchmark cognizant. As a team, we thought if we liked a stock, you buy 5% and you're good to go. That's how we managed our portfolios. But that doesn't work anymore. We mentioned that with precious metals now being 21%, you might think, if I really like gold and PGMs, I'll make it 10% of my fund. But you have to realize that that means you're actually underweight relative to your benchmark. And so the right holding to have is 30%, if you really want to express that you like it a lot more and you think it'll outperform the general market. So that's something that's changed for us from a process perspective. We became a lot more benchmark cognizant, and that's contributed to more consistent outperformance over time. And then secondly, getting in and out of stocks. So this is an example we really like because we don't always get it right. And when it came to transaction capital, we were on the wrong side of that. So we held the shares into that trading statement that was quite negative. And I think that's where after I joined 361, it was the first landmine that I saw in our fund where we had something go wrong. And it was really incredible to see our senior PMs be very decisive, tell our trader immediately we're getting out, and it probably took us less than half a day to completely exit that position completely. And we even know some of the managers that we did sell the shares to, but that's not important. But what we'll also do in different market environments like now, where you are in a kangaroo market, is we won't hold as many smally liquid shares. So we also manage that risk in that regard. So on a single stock, we can get out, but you also, preempt it. At a time like this where there's lots of volatility, you'll have fewer small caps than you would, let's say, last year, where you've got GN euphoria and, all of SA is just going up.
Always interesting when you exit a position, somebody has to buy it. So I always wonder who's buying it. Is it the red guys, the blue guys? I don't know.
A couple of blue guys, but yeah.
So Lily, thank you so very much. Thanks for your time.
Thanks, Eugene. Thanks, everyone.
Good. Thanks. Right, last push or last session before we're going to break for tea. We're not there yet. Walter Jacobs from Blue Alpha coming to the front. We are dealing with multi-asset funds. Always a good time to test their views and asset allocations where they are and where the opportunities are. Walter, thank you so much for being here this morning. Thank you.
Thanks, Eugene. Okay, good morning, everybody. And as Eugene said, last push before a break. So I'm going to talk to you about multi-asset, but actually it's not going to be that much different to what you've heard probably all morning. And that is all that glitters is gold, or at least on the Johannesburg Stock Exchange, but also in many of the other markets. So some of the drivers of gold, the major macro uncertainty that arrived in the world with Donald Trump. His tariffs on, tariffs off, dealing with partners on a transactional basis, seeing what is good for the US, and then just changing his mind on a very regular basis has created a huge uncertainty in capital markets. And it's something that's not going away, where investors were typically seeing, investors and countries were seeing the US as a safe haven. This has damaged the psyche of these global investors, and it's going to last for a while. And he's not done. He's busy meddling with one of the most important central banks in the world, the Fed, and implications of that can be further dislocations in the markets. So all of this has meant that there's been a recalibration of what was thought to be safe haven assets. The US dollar in the past was the go-to currency when things were going wrong. People were parking their money in dollars and treasuries, and this has already started to change, but this is going to carry on for a while still. And also the size of the US market, the size that has been over time that's been accumulated in these US assets, makes that even a small shift away from US assets causes big dislocations in other markets. And that's why we're seeing these strong rallies in the likes of gold. And in the past, if you go back over time, gold has had quite a low correlation to other asset classes. So it didn't move the same way, and that helped it as a asset class of safe haven assets. Recently, its strong performance has actually coincided with what is happening in equity markets. So I mean, this is in broad terms what I'm going to talk about, and I'm going to expand on some of these thoughts. Just again, something about us. I'm Walter Jacobs, CIO at Blue Alpha and also a portfolio manager. We've been around since 2003, and we run a number of multi-asset funds and equity funds, both local and global. I'm not going to dwell too much on this. I'm going to get to just how we go about things. So asset allocation, we've always felt that tactical asset allocation doesn't really add value over time. There's actually very little evidence that supports that over time somebody can tactically allocate consistently well. Although if you can time it, there is no question that can add significantly to performance. So we utilize what we've seen in the past as being good asset class performance and understand where we need to allocate based on that. And we use the strength of our equity franchise as the building block for that. And we just believe that we manage risk slightly differently to the big guys, where the big guys will go for bonds, typically as a diversifier away from equity. We typically look at things like gold and commodities. Our investment philosophy is typically bottom up. So we'll describe ourselves as a quality manager with a growth tilt, and the thing that we care about most in valuations is free cash flows, and I'll talk about that when it comes to the gold sector. And we're not macro forecasters. That doesn't mean that we don't care about macro. We just don't forecast macro. We observe what's currently going on and then understand what is the risks and adjust portfolios accordingly. So this is just a study that was done by SBG, so Standard Bank's equity department. And this looks at asset class performance in a South African context from 1976 to 2024. And what you see here is various time frames. So the table on the right is various time frames that they're cutting it. And they're looking at asset classes like equity, property, gold, inflation, and bonds. And when you're looking down the table on the right and you look at gold, you see that in a number of years, gold has a 1 next to its name. That means it was the best performing asset class in that particular year. Now, this gold that they're talking about here is a coin. So it's the rand price of gold. So 2 components, the gold price in dollars and rand. So it's not the gold companies, it is the gold ETF, you could even say, as a proxy for that. And what we can see is that gold is consistently ranked one of the better asset classes for a South African investor. Now, if you went back 2-3 years and looked at the study, gold wasn't as prominent, but it was still one of the top 3 asset classes. So the recent strong performance has obviously pushed it to the top and has even impacted the long-term performance. But as I said, if you go back 3 years, you would still find it in the top 3. And so gold is really something that we believe that an SA investor cannot ignore. And a number of speakers has mentioned this already. Is just what has happened to gold and platinum in the indices. And you can see that 5 years ago it was a lot larger, became quite a bit smaller, and gold specifically has significantly re-rated in terms of its size in the index in this year. Now, I've got now there, but that now is at the end of August, and both gold and platinum, because of price movements and corporate actions, has already been upweighted again in the indices during September. So it's really at plus 20%, something that you just cannot ignore, and therefore something that you should pay close attention to. And what I've just showed here is Blue Alpha's multi-asset funds. And then what I also did is I looked at the fact sheets of the major players in the multi-asset space, in the multi-asset space on the CISA categories, as at the end of June, obviously. That's when we have these fact sheets generally available for everybody. And it's the four big players. And you can see that their exposure is quite a lot lower than what we have at Blue Alpha. And as I said, we typically do not play as much in the fixed income space as these other players would. We use gold and precious as the offset for equity risk. So, you know, is this just something that's completely away from our process? I said we're quality managers with a growth tilt. And what I'm showing you here is the cash flow return on investment. So that's just how good a company generates cash flows from its operating assets over time for the gold and precious sector. So it's the large gold companies and the large platinum companies aggregated, their cash flows relative to the assets that they have. And what you can see is over time, these are cyclical value creators at best. So cyclically, they are quality businesses, and clearly over time, there is also a cyclical element to growth. And what we can see is that these trends can typically sustain for quite a while. So it means that when this trend in gold goes away, we're going to have to be very careful about what happens to these companies' profitability. Because as you can see in the earlier part of this chart, there is a significant period where those bars are declining, and they're below the red line, which is the long-term cost of capital. And during those periods, gold will significantly underperform. And we've seen it in the past. We've seen that these gold counters underperform significantly, and the likes of Sibanye-Stillwater has been taken to the wall and had to issue stock, and similarly with Harmony. But right now, we're in a very strong upcycle. The reasons for this upcycle is probably going to prevail over time, and it's not just in gold, it's in platinum. And so what we're just showing here is the deficits in the platinum market, and that's one of the reasons that's supporting this price. And we think that these negative supply-demand dynamics or the shortages in the platinum market is going to prevail. These miners have not invested in bringing mines up to or expanding mines, and although there is weaknesses in the auto market, just the contraction in the gold in the platinum mining space is going to allow for this price to sustain, and we believe the performance to sustain. Various speakers spoke about dollar and the de-dollarization of safe haven assets, and this is just another chart that speaks about that. It's been ongoing for a while, and as I mentioned right up front, we don't think that reasons for that is going to go away. We've seen this surge in central bank buying. It's mostly been from emerging markets, but there is scope for some of these other larger central banks also to get involved. And what this chart wants to demonstrate is just if spot prevails where we are right now, there is still some significant earnings upgrades that need to happen. So the market analysts looking at these counters have not factored in the full benefit yet of these prices. And so what you see, that blue circle is for the platinum counters. So there's most upside to earnings if spot prevails for the platinum market. For the gold market, because that's gone on for a long while already, not as much upside, but still upside to earnings. And then finally, for the rest of the material space, there is actually probably more downside to earnings. So the bottom circle that you see there, that bottom gray circle that you see there, that's Glencore. And there's still downside risk to its earnings, predominantly from coal. And the top right, the blue circle there, that's Sibanye-Stillwater. Obviously, it has both gold and platinum exposure. So a very different materials sector that we're seeing in SA, where precious, and people have showed that, where precious metals have done all the running. But we believe more legs to come, because if spot prevails or even go higher, there is still going to be upside risk to earnings. So yeah, just in conclusion, we think that the factors that has driven this rally in precious metals is sustaining for probably the next 3 years. There is deficits in the platinum market. There is weak supply in autos, but that deficit is gonna prevail, and that will sustain the price. And what we have ongoing in the US with Donald Trump and the way that he's reacting with all of his trading partners, and just the damage that does long term to people's perception about can you really trust the US to be the go-to place in the past, is just going to last a lot longer. So, we remain overweight these sectors from a multi-asset perspective as well. Thanks, Eugene.
Thank you, Walter.
And maybe I forgot that. So this is a quote from Goldman Sachs, that even if just 1% of privately owned U.S. Treasury. So this is not the central bank market. The private market actually is a lot larger in U.S. Treasuries. And if 1% of that shifts to gold, they say it can go to $5,000, and there is others that have a $6,000 target price. So again, I know it's a consensus thing, but sometimes consensus can be right.
Second time this morning, we're hearing 5,000. It's starting to sound like an auction, isn't it? But, Walter, we've got very good ideas as to what worked and your views going forward. But just very quickly, the past 12 months, what did not work, and did any of your positions change?
Yeah, so going into 2025, we came off quite a good 2024. And we were, as some of the speakers had said, we were in the likes of some of the banks, local banks, the retailers, and specifically in the retail, we were hurt. But we've cut down on those positions and in favor of the golds. Just number of speakers mentioned the GNU and where we're going, and it's just going to be tough. We need, as we've said, changes in the country. I mean, if you look at what's happening specifically in our area, Gauteng, I mean, what you have is rates and taxes continue to go up. service delivery going down, potholes going down, Joburg water. So these things are really impacting not just people's psyche, but their pockets. And so these retailers are just going to take longer to recover, and you're going to have to be very selective in that. And there is no growth in those companies. So if you look at share price, earnings growth, you're probably looking at 5 to 10%, and you're getting 200% in platinum. Like there's just no comparing what's happening. So yeah, a shift from the retailers specifically into the precious, and just lightening some of the banks' position, but we're still overweight banks.
Cool. Walter, thank you very much.
Thanks, Eugene.
Oh, Walter, sorry, there's one question from Pierre. Yeah?
Hi, Walter. Pierre de Klerk from Apex. Can you just quickly talk about your global geographic makeup? Historically, you've been quite heavily invested in the US, but last time we engaged with you, you kind of did say or did hint at the fact that you're looking elsewhere. Obviously, you're also observing the valuations and the concerns around the US that everyone else is. So have you made any significant changes in your geographic exposure in your global portions?
Yeah, thanks, Pierre. I mean, 100%. That was the thinking. But what I will say is that in the US, I mean, you still have a very, very dynamic market. With AI specifically and the way that capital is allocated, you just do not see that elsewhere in the world. And so we're believers that the US will lead the way in AI, and so we still have significant exposures there. And also, when you look at the companies that we invest in the US, the likes of Meta, etc., more than 50% of their revenues are outside of the US. So that's always one of the things that we point to, is actually have a look at the underlying profitability of these companies. A lot of them also have significant EM exposures. I mean, Apple, the iPhone, you just heard again with the latest release of the iPhone, I mean, China has ordered significant amounts of the iPhone, etc. But yes, we've made some changes. So Novo Nordisk, post its large slump, has come into the portfolio. We have Alibaba, we have Tencent. So on the China side as well, because some of the US tech has just become too expensive, and the likes of Tencent and Alibaba offer much more value for the AI exposure. Yeah. Thank you.
Thank you, Walter.
Thanks, Eugene.
Right, next up, we've got Philip Short from Flagship Asset Management. I realize this morning is starting to get a little bit long. We're almost there. But Philip, thank you very much for your time this morning. Floor is yours. Click here there. Thank you.
Great. Morning, everyone. Philip Short from Flagship Asset Management. I think important to point out is that we are globally first focused on, we first focused on global investments and portfolios. Our first portfolio was launched in 2001 out of Cape Town. And I think it's very important for South Africans to have exposure to global markets. So the JSE, or all the companies on the JSE, have a combined market cap of 1% of the total market cap in the world, and 4.4% of the world's GDP. So it's not just to people that are in South Africa that I say this to, but people that are in Australia, Mexico, Japan. You've got to invest globally. And you can do that from South Africa. You can do it from rand-based accounts, like with Flagship. So bearing that in mind, a lot of what I'm going to be talking about has a global focus or a worldwide focus. Okay, so markets are pretty expensive, or very expensive. If we look at the All-Country World Index, or the ACWI, it's trading at a 19 times forward PE, relative to its 20-year forward PE median of 14.7. So it's about a 30% premium. On the next slide, I'm going to show you something similarly, but by geography. So first, just look at the left bar. That's the US. And if we look at the red bar, that is showing you the range of the forward PEs where the S&P 500 index has traded over the last 20 years. But to exclude outliers, I've just used the 10th to 90th percentile. So we can see over the last 20 years, the S&P 500 has traded at a 12 times minimum PE and a 21 times maximum PE. The white dot is the median forward PE over the last 20 years, and the blue dot is the current forward PE for the S&P 500 index. And that is in outlier territory, so it's in 90th to 100th percentile. So certainly very, very expensive relative to its own history. Next to that is ACWI, the All-Country World Index, also very expensive. Europe, Japan, and China, slightly less expensive or moderately expensive. And then South Africa, they're the only one with the current forward PE, which is below its median PE over 20 years. Now, importantly, valuation should never be taken or seen in isolation, because markets can stay more expensive or very expensive for much longer than one can anticipate. And sometimes for good reasoning as well. There might be very strong underlying earnings growth, or the interest rates might be coming down. So the last time I spoke at a BCI conference was in April last year, and I showed the asset allocation of our worldwide flexible fund. And that would be on your left. And that was the 31st of March. So we saw a 73% equity allocation globally, 7% gold and cash 20%. On the right, that's updated to the end of July. That equity allocation has gone up from 73 to 84, and that's been taken from cash. Now, we've done that whilst generally markets have become more expensive. So the question is why? So we use a top-down and a framework. Bottom-up work identified some really great stocks that got sold down in April and in May on the back of the tariff and trade war headlines. So that was the bottom-up work that we did. On the top-down, we look at a number of macroeconomic key points, but the one really important one was global liquidity, and that's still screened quite favorably. Yeah, I've taken the S&P 500 index over the last 5 years and overlaid it with global liquidity. The global liquidity is defined by M2 money supply, and M2 money supply is basically just all the liquid cash that's out there. It's what's in your pocket, what's in the bank accounts, your savings accounts, your money market accounts, but it is not what you've invested in equities, in property, and bonds. So this is just sort of cash that's sort of slushing around. And you can see they track each other quite well. Now, if central banks cut interest rates or initiate quantitative easing, global liquidity goes up, and that's positive for equity markets. This is the same chart, but just going back 16 years to show you that the relationship still holds for over longer periods of time. So the question is, where to next for global liquidity? So if we look at the interest rate cycle part, this chart shows you where the world is in its interest rate cycle. Now, if I look at the red line, which uses the left y-axis, it tells you that the percentage of central banks whose last move was a rate cut as opposed to a rate hike is sitting at 80%. And then the gray bar is on the right axis and is the same data, but weights those central banks by the country's GDP. We're also working at about 80%. So you can see for the last year or so, central banks globally have been increasing, or the percentage of central banks have been increasing in cutting rates, which has increased global liquidity. So the important question is, where to next for global liquidity? So I think the US Federal Reserve is widely expected to cut rates later this week, probably largely priced into the markets. But now people are starting to expect an additional 1 or 2 cuts in the US later this year. So the risk is that although markets are expensive today, that they might be even more expensive come December. What we would be keenly looking out for is as that cutting cycle starts turning. Now, you can still have that positive, let's say at 60% of world central banks cutting, But that delta, which is negative, means that there is liquidity leaving the market. And that is negative for global equity markets. So it's something that we'll be keeping an eye on quite keenly. And for us, risk management is not just about avoiding the losses, but it's about participating in the gains as well. I remember one of the senior mentors that I had at Flagship, he's over 80 years old now, but he said, I think it was in 1990, 2000, markets were very expensive, and he sold all his equity holdings, and then the markets doubled from there. So, it's about having that experience and being cognizant that valuation doesn't drive 100% of outcomes. You have to look at different things, which is why we use top-down approach as well. Okay, interestingly enough, I didn't know gold was going to be such a focal point today, otherwise I would have brought a lot more slides with me. But as a fund, we are multi-asset, and you would have seen we own 0 bonds, but we are invested 8% in gold. And I think listening to a number of the people here, I agree with all the things that they say in terms of what's happening in the world, but the most important, and this is obviously my point of view, the most important reason for gold and where gold is going now, it is now the truly risk-free asset of the world. Shortly after Russia invaded Ukraine in early 2022, the West and the US froze Russian foreign reserves, including Russia's holding of US treasuries. That's US debt that they owned. So the USA froze that. They weaponized US treasuries by doing that, and in practical terms, they defaulted. The US defaulted on their debt by saying, we're freezing that, we're not going to pay that. And some of the Europeans are saying, not only are we frozen that, but we're going to take some of that money and we're going to give it to Ukraine. And straight away, you started seeing big players, especially the BRICS, selling down US treasuries, their holdings of US treasuries. And why? Because they might be next. And what you saw at the same time is central banks around the world starting to buy gold, and lots of it. Now, the slide I would have brought with me, if I had known it would be so topical, is to show you historically, gold has almost a perfect correlation to negative interest rates, US rates. So nominal rates minus inflation. When that's negative, there's no opportunity cost of holding gold, so people pile into gold. So when we saw that decouple in April, May in 2022, saw central banks buying gold but selling treasuries, we thought at that point in time was the Rubicon of gold taking over US treasuries as being the truly number one risk-free asset in the world, and which is why we'll continue holding it. We are 0% investing in bonds, which is pretty strange for a multi-asset portfolio or fund. And let me just start with the US debt. So we know that US has a spending problem and a debt problem. On my way here, flying from Cape Town, I saw that the August budget for the US, they raked in $350 billion for the month of August, which is almost entirely from collecting taxes, corporate tax, income tax, $350 billion. And by the way, this isn't new. This is every month for the last 2 years or 3 years that I've been tracking it. What they spent was $750 billion. So that deficit of $350 billion has to be financed with what? It's debt. Okay, so, and now think about it, the other line item, the third biggest spending point after Medicare and Social Security and above schooling, education, and even defense, was net interest expense of $100 billion. So they've taken in $350 billion, and there's $100 billion of that is going to paying interest on debt. And I've said this before, but they are in a situation, and it first happened now last year, where they've had to take new debt, which all countries and companies do, to pay off old debt or roll over debt. But this is the first time that they had to take out new debt just to pay off the interest on the old debt. So that's like me and you having a credit card to get through the month. We max out that credit card, but now we've got interest, and our paycheck can't pay the interest on that credit card. So what do? We take out a second credit card. Not to pay off the debt on the first credit card, just to pay off the interest on the first credit card. So that we're staying away from US debt. Similarly, which has been quite an anomaly, since 2022, developed market debt volatility has been greater than emerging market debt volatility. The rest of Europe and developed markets are not far away from the US situation. So we're not touching DM or developed market bonds. We don't hold SA bonds, and SA bonds actually did pretty well this year, so well done if you held that. But our decision was to hold gold in our portfolio and not SA bonds. So we're happy with that decision. So what we're watching, also we're very active, and what we do is we do a lot of our research not on what we see today, but what we expect tomorrow, so that when it does happen, we can react quite quickly. There's no point in saying, I think a recession is coming tomorrow. You make your portfolio, construct your portfolio for a recession, and then there's no recession because those things are very hard to predict. And then you haven't participated in any upside in the market. So we like to be as close to current data as possible and respond to data as it happens. But we respond to that data by having done earlier research on that. So the main things that most multi-asset managers will look at, you got there, inflation, US bond yields, rate cuts, etc. But the one that I would like to highlight is, at some point, the market's going to correct. I don't think it's going to correct heavily due to the global liquidity by December, but let's say something happens next year and the market's correct. I wouldn't be surprised if we see some sort of QE, quantitative easing, or yield curve control out of the US, which is going to flood the markets full of money, which is going to get that global liquidity coming up again. So my go-aways are, market could still get more expensive from here into December. I don't know what's happening in 2026, but looking at the valuations where they are, we could see a good correction. Post that, be ready for any liquidity that's being injected into the market. Our biggest tool is risk mitigation at Flagship. We have designed some tools that allow us to let our winners run for longer, and we'll cut our losers quicker. That does mean that we'll usually have a higher turnover, but we'll rather cut a position that's down a certain percentage point at the risk of holding it and losing more money. Over time, the best performing asset class is equities, or are equities. So we usually have somewhere between 65 and 95% of the fund in equities. We're unconstrained, it's flexible, so we can hold 0% in any asset, we can hold 100% in any asset. It's a worldwide fund, so we can hold 0% in South Africa, or we can hold 100% in, name a country. We're nimble, we can act very quickly. Like most people here, we are boutiques. But playing in the global markets, you even get to be more nimble. So if you do own Meta, we can sell within a second without really moving the share price. We're truly global. So most of our peers who now manage global money, most of our South African peers, they first started cutting their teeth investing locally, and then once they got maybe too big for the local market, then they went globally. Our first fund that we launched in 2001 was a global fund, so that is in our DNA. And we have a 21-year track record, 24 track record, having started in 2001. And then the last slide, we've outperformed our benchmark since 2001. JD Hayward, the co-manager, and myself, we took over management of this fund 2 years ago, and we've continued the good performance of outperforming the average of our peers and our composite benchmark. And I'll leave you with that. Thank you very much.
Philip, thank you very much. Just want to check any questions. Right, I really want to get to tea. Are you staying for tea? So if I want to engage with you, can they?
Yes, sure. I'll be around for about half an hour, and then I'm in my rent-a-car on the way to Joburg.
Fantastic. Thank you so much.
Thank you.
Right, we're going to have a very short update from Centaur Asset Management done by Lang Walker. He's based in London, so it's unfortunately not here in person today. It's going to be a very short update focusing on the global side in the Centaur flexible mandates. Thank you very much.
Hi everyone, my name is Lang Walker. I manage the offshore part of the Centaur funds. I've been involved in the offshore side of the business for about the past 8 years. And today I'm actually presenting from London, so my apologies for not being there in person, but I'm very excited to dive into our topic, which is the art of capital allocation. I'm going to be particularly approaching this through the lens of our offshore holdings in our multi-asset flexible fund. So let's dive straight in. I think that we can all agree one of the most important drivers of stock prices is earnings per share growth, EPS. Now, this is something we may know intuitively, but it's been increasingly documented that the best CEOs, the best capital allocators, can compound earnings per share at nearly twice the rate of their peers. Now, capital allocation for CEOs really means how they spend their cash. Is it growth? Is it mergers and acquisitions? Is it capital returns? Is it debt? And these activities all drive the business's growth and competitive advantage, but how a CEO goes about putting together the right mix of these factors is really all about these key soft issues that sit beneath everything else. Now, when I'm talking about soft issues, I'm really talking about a few things. The first big thing is customer and product obsession. The best CEOs are always thinking of the customer's pain points and what the customer will need next, always thinking of the next profit zone. So a great example here is Reed Hastings and Netflix. He recognized the customer's frustration with cable TV and wanted customers to gain back the power of choice. And this led to the advent of streaming, which was very transformative, as I'm sure we're all aware. I think the next big thing is being long-term focused, as opposed to managing the business to beating, quarterly earnings. So a great example here is Jane Sun, the CEO of one of our holdings, Trip.com. She killed all the profits this year to reinvest into this international expansion. Now, this could be a 1.5 times larger market than China, which is a domestic market. It could dramatically improve the intrinsic value of the business. And in order to execute on this long-term strategic initiative, she had to initially kill profits. Another big thing is mental flexibility. What we're talking about here is really how much the CEO can pivot as soon as the facts change. So a good example here is Daniel Ek at Spotify, a business we used to own across the funds. Now, he quickly pivoted away from a growth at all costs mentality to a focus on profitability and margins. And I think using Daniel Ek as another good example is skin in the game. Usually when the CEO's fate is tied to the stock price, we find the CEO acts more proactively, more like a business owner versus a shopkeeper. And, with Daniel Ek, he founded Spotify. He still owns 10% of the business. He doesn't even draw a salary. His wealth is directly tied to the share price. And, the share's had tremendous success. It's up multiple times over the past few years. And finally, it's about understanding the value creation drivers. Does the CEO understand what drives business value, what shareholders want? Do they understand critical terms like return on capital, reflexive share buybacks, exiting assets, cutting unprofitable business lines, optimizing costs? It's really about knowing what levers to pull to maximize business value. Now, these masterful capital allocators have compounded at near twice the rate of the S&P over the past 20 years. So I think now let's look through some real world examples, businesses that Centaur's been invested in or is currently still invested in. Something like Dell. So Michael Dell at Dell Technologies, he started the business over 40 years ago. He still owns nearly 50% of the business today. And really what he focused on becoming was the lowest cost producer and sharing this advantage with customers via lower pricing. This meant that Dell always delivered the best deal in the room. And while everyone else was trying to rely on traditional distribution or traditional supply chain or reseller channels, Dell pivoted to going direct to the customer and built a unique, dynamic, flexible supply chain that was unlike anything we had seen. He was also always thinking of the next profit zone. A great example of this was Dell was already positioning for AI years before ChatGPT even got released. And so they were quick off the bat and things started to gain momentum. He's also very financially savvy. He knows what shareholders want. So he spun out VMware. He paid down a lot of debt. He conducted large reflexive buybacks. If you put all of this together, the end result is Dell has gone up over 3 times since he spun out VMware in 2021. I think another good example is Pony Ma at Tencent. Now, he founded the business near 30 years ago. He's still there today. He still owns 8% of what is a very large market capitalization business. Excuse me. Earlier on, he spotted that there was a lot of friction in everyday Chinese digital life. They want to be more social. They had issues with sending gifts, with juggling between multiple apps. And so while others were focused on single service products, he sought to create this super app ecosystem that resolved all these customer pain points under one roof. So for a long time, it was just about land grab and gaining market share. Even Tencent's cost ballooned eventually, but Pony quickly pivoted back to a focus on margins and cash flow growth by cutting weak products, by cutting excess fat and costs. And he also began becoming more aligned with shareholders. He distributed some assets like Meituan. He did large share buybacks. He's been growing the dividend every year. So it's a business we previously never owned due to the Chinese backdrop, but watching Pony Ma execute so strategically, we actually got involved and the shares doubled over the past 3 years. But looking at the opposite side of the coin now, looking at some poor capital allocators, like Francois Pinault at Kering comes to mind. He owns 42% of the business. He's part of the founding family. And really what we found over time is that he just runs a business for the enrichment of the family versus shareholders. So profit maximization was prioritized over the strength of its key brands like Gucci and Yves Saint Laurent. They expanded the brands way too quickly to maximize profits, and brand equity suffered. And to get out of the hole, they started buying more expensive and actually immaterial assets that worked to stretch the balance sheet and eat into the returns on capital the business made. So we put this mosaic together quite early on and realized that Pinault was becoming a bit of a cowboy with shareholder capital. We exited quite quickly, and Kering's share price has actually more than halved since. I think the next good example is Jette Nygaard-Andersen at Entain. She held minimal interest in the business while she was actually its steward. And under her watch, Entain's products began sort of lagging competitors, particularly in the most important profit zone in the world, which is the US. And instead of nurturing a critical relationship with BetMGM, their US partner, who actually wanted to acquire the whole of Entain, she went on a high-priced, value-destructive acquisition spree that wrecked the balance sheet. She basically conducted a quasi-poison pill to deter BetMGM from buying Entain entirely. So we noticed Andersen started to go rogue. We actually exited what we'd actually switched into Flutter, and the Entain share price is more than half following this. So assessing whether someone is a superior capital allocator or not has really become a pinnacle pillar of the Centaur way over time. We understand that hanging on to these superior allocators can drive excess returns over time. But we also understand the opposite is true. Avoiding these poor capital allocators that destroy value may be even more important over the long run. Now, it doesn't mean we won't own a cyclical or kind of lower quality business over the short term, perhaps for a trading opportunity. But this means we're very picky about the businesses we invest in over longer periods. So I've tried to quantify this using the table shown. You can see that Centaur's holdings are growing faster on a revenue and earnings per share basis, more profitably, looking at the margins and ROIC profile, and trading at a discount to high free cash flow yield. And this is largely the result of us being invested in these superior capital allocator-esque businesses. So it's not just on paper that we believe, these holdings are superior to the benchmark. It's also on this critical soft issue basis that we've been talking about today. But I think that just like our CEOs strategically allocate capital, we as investors have to strategically allocate capital across asset classes at the portfolio level. What we found over time is that through the strategic asset allocation, combined with stock picking alpha, you can beat even the best performing asset classes over time. A good example is the Centaur Flexible Fund is a South African-centric portfolio, and yet it's beaten the MSCI World and the Morningstar Developed Market Index over time. The Flexible Fund particularly is our performance benchmark over the medium and long term by about 1% and 3 percentage points respectively. An observation we expect will continue in the future because we believe that ourselves have become thoughtful capital allocators over time, just like our sort of investment CEOs have. So just to run through some of the changes that's occurred in the fund over the first half, our bond exposure and South African equity exposure is relatively stable. Really the key takeaways, we've been deploying more cash into new offshore ideas and upweighting our offshore equity exposure, particularly in light of the AI theme. And I think these allocation decisions are probably better explained by elaborating on our outlook a bit more. So, in South Africa, we think the South African Reserve Bank has been on the back foot in cutting rates. We think this GNU relationship is somewhat on rocky footing, but we are seeing some gradual structural reform. We do think that lower rates will stimulate more consumption over time, and valuation versus growth still remains attractive, particularly in certain pockets of the market. A good example would be South African banks. They're trading on multi-year low PEs, but you've got high single-digit earnings growth, high single-digit dividend yields. It's quite easy to see 20% IRRs over the next few years. But really, the opportunity has been offshore this year, where economic growth has been much stronger. There's potential for US rate cuts, and there's just a host of exciting themes that we can gain exposure to, from AI to cloud, digital banking, to electric vehicles, to streaming. Now, there is a lot of volatility offshore. A lot of shares these days are moving 10 to 20% on an earnings release or a piece of news flow, but this is equally creating exciting buying opportunities for us. So I think to conclude, we've had a tough year-to-date performance. We have been here before. We're committed to playing our own game. I think we've got a proven kind of rule book. We're taking active bets in the markets. We think that there's scope for SA to perform, but really we're most excited about our investable offshore ideas and themes. And I think overall, the team remains confident that the central BCI funds will outperform their respective benchmarks over the medium term. And I just want to say thank you so much. That's basically the end of the presentation. And I look forward to hopefully presenting next time in person. And I'll see you all soon. Thank you.
We continue on SA property. Like most asset classes, SA property also did extremely well over the past 12 months ending August, giving clients almost 20%. But I think a lot of clients are asking now, was this just SA property coming back from an all-time low and almost just re-rating? Valuations are still attractive, but where to from here? It's my absolute pleasure to welcome Evan Jankiewicz from Ses Fakile, the property experts. We're going to focus on SA property, but also manage global property portfolios. And I encourage you, if there's any questions on property after the presentation, more than welcome. Evan, thank you so much.
Thank you very much. I'm not going to use that stand. I'm just going to walk up and down because no one's sitting behind me. But what I'm going to speak to you about is listed property in South Africa. It's been an amazing, not 12 months, it's been an amazing 20 months. We've done pretty much 40 or so percent since the beginning of last year. And, all I get from people time and time again, has it run too hard? Should we be taking profits, running away? You've got to stick to your basics. You are building a diversified portfolio. You're not here to time the markets. But what I really want to show you is that there is still value. And I really want to show you a little bit of a history. We've all seen that huge rally with a little bit of a hiccup from 2004 to 2017. An amazing, call it trebling in returns of total returns, 200-300% if you were in certain stocks. And then, you had a great run, but then you had those hedge fund allegations, you had Ramaphosa fading away, COVID. You saw a stark drop-off. Yes, that peak was probably not justified, but that sell-off wasn't justified either. And what we've seen from that trough to where we are now is a circa 45% capital upside. 45%, that's a huge number, but we're still where we were in 2011. We're nowhere near the peaks. So what I'm trying to say is that a lot of the strength that we've seen over the last 20 or so months has been catch-up. It was oversold, and we still believe there is value. Not just because it didn't catch up enough, but the fundamentals are looking significantly better. And we'll speak about that going forward. So just before we speak about the fundamentals, to understand when we say South African property, it's not really just South African property. Call it circa 50% of it is SA, whereas the other 50% is generally Europe, UK, Western Europe, Eastern Europe, and a little bit of Australia scattered here and there, and a really, really small amount of US. So we are actually looking at with a bit of a global view here, most of it being in Central and Eastern Europe, predominantly Poland and Romania, which have been very, very robust markets in the last, call it 15 or so years. And of that, never mind the geographic exposure, your actual see-through exposure is generally dominated by retail, with a bit of office following there, and logistics. So every time someone says sell property because we've seen so many vacancies in office, understand that only 15% of that is in office, and our exposure is probably significantly lower than that, at about circa 10%. And of that office, some of it is actually doing very good. So, for example, some of our exposure to office is in Germany via a company called Sirius, which has had unbroken capital growth and earnings growth even through the likes of COVID. So you've got to take it with a pinch of salt in understanding what you're actually investing in. So we're going to start with retail. Retail has been really robust. Obviously, we had huge headwinds coming through out of COVID. So we saw COVID where people weren't allowed to shop. We saw a spike in vacancies, but we've come back very strong on the back of that. So you can see vacancies sparked at 4.4%, which itself is really not a high number at all. In the listed space, it was even lower. And through that, the recovery has been quite robust into, call it circa 3%. We learned through COVID that we are social animals. We want to be seen, we want to feel, we want to touch. So yes, we can all shop online, and I'm sure we all do, but I'm sure we all go to the shopping centers as well. We go to restaurants, we here and there go see a movie or two. But the likelihood is that everyone around here will go to a shopping center. So what we've seen through there is that even in the call it the face of online trading, as it exponentially grew through COVID, we've come back strongly, and people have learnt, and the retailers have learnt, that you can't just have an online presence. You have to have bricks and mortar. You have to have that to have a profitable business, because online retailing is not profitable. Even the likes of Amazon, for the first time, their online trading, I'm not talking about the cloud business, but their online retailing has just become profitable. These are the most dominant guys in the world, because why is that the case? Reverse logistics is very difficult. You need 3 times as much space to actually take those returns back. I know my wife, she orders a fortune and she returns almost as much. So you need space to take that back. You need to fix it. Someone wore a pair of whatever it may be, you've got to clean it, some of it's got thrown away. So that is costly. So you need those bricks and mortar. And then we go to the last bit over here. Well, no, not before the last bit. You've actually seen reversions in rentals actually slightly higher. We've had 2 sets of results that came out this morning, Hyperop and Attack. And they are generally your more affluent shopping centers, the likes of Hyde Park, Rosebank, Canal Walk. Atterbury's got Mall of Africa, Lynbridge are over here nearby as well. And they saw, on average, 5% reversions upside on renewals. That's over and above the escalations of around about 7%. So that means your net operating income is probably growing about 8 to 8.5%. That is decent growth. That is above inflation growth. And with that said, as you can see, that's not all done. As I said, the fundamentals are better now. What we call our sweat or effort ratio has gone through from COVID of 8.5% all the way down to, I can't see about around about 7%, 6.8%. What is that effort ratio? That is your rental divided by your turnover. So the lower it is, the more affordability your tenant has to pay higher rentals relative to their turnover. So we're still saying that retail is in actually a good space. And why is it in a good space? Is because not only are we seeing fundamentals improve from a demand side as interest rates are lower, inflation is being controlled, but there's been very little relative supply that has come on in the last few years. So yes, there have been scattered developments, more so than the likes of office and industrial, but relative to the demand pickup, there hasn't really been anything of substance that has come to the market in the last 5 or 6 years. Then we go to office. Office, unfortunately, is not as pretty as the likes of retail. It has been, for lack of a better term, a swear word in the last, call it 15 years in the property circles, but it is coming off a very low base. So we saw our average vacancies spike at about 13.5%. Your average vacancies now are about 11.5%. But the stuff that we invest in, so you can see what I've got here, the vacancy per grade. And you can see prime grade, which is the best, is at only 5.7%. A grade is about 11%, and B, C, and call it the rest, are higher than that. Of our exposure in our sector, never mind our fund, only 2% is not either prime grade or A grade. So the listed sector only invests in the best of the best, generally speaking. So you can see it's actually improved a long way. And once you see vacancies around about 5%, you'll start to see upward rental tension. For the first time in a long time, we've seen positive reversions coming through in an office property, and that is a positive sign coming through. And more than that, again, it's always about supply-demand. Demand in office is all about GDP. Unfortunately, it's been somewhat flatlining for the last 10 or so years, but supply is non-existent. This is the average supply in office over the last, call it 15 years, and you can see that there is literally no supply. We've had a year that you actually had negative supply. How do you build negatively? Well, actually, they turned some of the office or older office buildings into residential. So you actually took some supply off the market. So office, I'm not going to say it's the best thing since sliced bread, but it is coming off a low base, and it is looking quite good at the moment. What is looking very good is industrial. And when I say industrial, we've got to change our mindset. This is not manufacturing, because unfortunately we don't do that very well anymore, but it's more so, it is logistics and it is storage. So e-commerce has been a huge underpin for that. People can't wait more than, call it 12 hours to get whatever they ordered. Checkers 60/60. We want it, and we want it now. And we can only get it now if you have the appropriate storage, or call it logistics mechanisms, in play. So that has been a huge tailwind. The other very big tailwind, which is not as apparent to many, is the actual supply chain. Especially, and I'm talking on a global scale, with all the geopolitical issues, with Brexit coming in, with our ports under huge strain with Transnet, we can't get things where, generally speaking, the big retailers had their whole process around just in time. Keep things moving very quickly, it's a lot cheaper. Now, you can't rely on that. It's now called just in case. So people are storing a lot more. So logistics and warehousing have had a huge underpin or tailwind from that. But then everyone asks well, if that's the case, vacancies are low, there's a huge demand for it, not so much supply, but why are those reversions negative, through the last, call it 8 years? The reversions were negative for one reason and one reason only. These are boxes. They were very easy to build, there was a lot of land available, and construction costs were very low. In the last 2 or so years, we've seen those construction costs fly through the roof. So call it 8 years ago, you could build at a 10% yield and charge 60 Rand a square meter. Now, to get an 8% yield on a break even on a new industrial unit, you need to charge 95 Rand a square meter. So we are seeing that uptick coming through on rentals, and you will see that going positive quite nicely going forward. So as I said to you, fundamentals are looking good on the three main sectors. We spoke about retail, which is call it circa 60, 15% in office and 15% on industrial. And then just another, I'll speak about your returns, and everyone says, well, property, bricks and mortar. But one of the big contributors to returns now is actually renewables, solar. This is an amazing thing. It's very seldom, I always say, do people see the positives in load shedding? So thank you very much, Eskom, for getting us in gear and rolling out a huge lot of these renewables, especially solar. So solar now accounts for 17% of consumption across our sector in the local space. 17%, we think that can get to 30% in the next few years. So every time Eskom or NERSA pushes the tariffs, we can actually get a better margin by passing it on to the tenants. Or alternatively, we can make it cheaper for the tenants and circumvent NERSA or Eskom for that matter. So when guys are buying assets or building assets at, call it 8.5%, maybe if they're lucky, 10, 11%, you're rolling out solar at about 17% yields, 17% returns, and I promise you, you are going to get that a lot easier than you're going to get paid rentals from your tenants. So that is another asset in itself that has really been an underpin for the property sector. The other aspect, as I said, SA property is around about 50%. The rest of it is predominantly in Europe. And it has really been a great story, especially in Central and Eastern Europe in the last 10 or 15 years. Underpinned by Nepi Rockcastle, which is the dominant guy over the last, 15 years. And it's really been a case of employment has been very high, or unemployment has been very low. Disposable income has been very strong. Interest rates have been low, and for a long time, inflation's been low, except for that blip we saw a couple of years ago. So the consumer has been very, very active. So you can see here, generally is that all of these are generally retail. So you can see they've been very underpinned by the strong consumer across Europe. Even Hammerson, which had a really rough run, call it 5 or so years ago, has come back with a vengeance. So, restructured their balance sheet, interest rates are lower, they've sold assets, they've streamlined, and those companies have done very well as well. But then you've also got the specialty REITs that have come through. Sirius is probably one of the best operational companies that I've seen in property across the globe, and we've looked at about north of 300 companies. It is German and a little bit of the UK of late. What they do is they buy cheap buildings, they refurb it, and they let it out, and they've done exceptionally well in that. It's more of an operational business, but again, unbroken growth through COVID and beyond. And then you've got the likes of Assura, which has recently merged or been taken out by PHP. That's more of a healthcare facility underwritten by the UK government. Great story there. And Shaftesbury Capital, yes, it is retail, but it really is central London. And an amazing thing there, why I like it so much, is that it's trading at about a 35% discount to NAV. But we saw the Norwegian pension funds buy their stake in their flagship assets in Covent Gardens at NAV. So if there's more evidence of what it's worth, well, that is it. When you get the Norwegian, one of the biggest pension funds or sovereign pension funds in the world, paying NAV, well, that's already an underpin to the price there. So things are looking good. And as I say, is that in Europe, the guys that are really doing well, if you look, the real income growth is really growing across Europe, but mainly in Romania and Poland, and that's where most of our exposure is, followed by the likes of the UK. So there is a strong underpin. You're still seeing discretionary income growing in Poland and Romania. I always say this, Poland, the average salary is about 40% of what it is in Germany. It's amazing, but if you say to yourself, well, why is that? In proximity, they're right next to each other. And people say, well, maybe they're smarter there, they work harder. I can tell you they work a lot harder in Poland. And your average university degree per capita is actually higher in Poland than it is in Germany. It's the highest in Europe. So these are very qualified guys, and they're going to demand more and more revenue, and that will underpin the spends on the likes of a Nepi, Mass, and the likes. Okay. Before I go in our outlook for the sector, we've got to speak about balance sheets. And very quickly there, we're in a much better position, or the best position we've been in a long time. Why is that? It's because COVID scared us into cleaning out those balance sheets, selling additional assets to write down your LTV. We peaked at about 42%. We're now sitting around about 36% loan to value. And your interest cover is a lot stronger as global rates are being cut as well. So asset side is looking strong, balance sheet side is looking strong, and for time's sake, I'm going to pop out to our positioning and an outlook. We still see value in the sector. I wish I could promise you another 31% that we did last year. I can't do that, but I can really say there is least value in the sector. 13, 14% is still doable in the following 12 months. You can see this is your property yield divided by your bond yield. The higher it is, the cheaper it is. It is trading slightly ahead of fair value, but this kind of green line over here is your inverted growth. So the lower it is, meaning its growth is getting stronger, therefore you should actually pay more for property. Growth, as I showed you, is looking better than it has in the last 7 years. So growth is coming back. We believe there should be a stronger re-rating. And priced to NAV, we're still trading at a 24% discount to NAV. And NAVs are not going lower. They've been stronger, actually. I just came from the attack results. Their NAV, if I'm not mistaken, was up 4.7%. So asset valuations are getting stronger, so why should we be trading at over 1 standard deviation discount to the last, 20 years? So we are pretty positive in property. Going through in the next, 12 months, we're looking at about 13.5%. Your biggest variable here is not what happens to ShopRite or what happens to Pick n Pay. Your biggest variable here is the long bonds. We got an exit long bond here of 10%. If we can settle at 10%, we should be comfortably getting 13% total returns, and we'll probably kind of taper out on that level through the next 5 to 10 years. Obviously, it's not going to be a straight line, but we still see circa 13% out of property. Hopefully, we can do what we've done over the last 15 years and beat that by 2% after fees. But the reality is, property game is not over yet. There is still value, and if you want to hold a diversified portfolio, you should still be holding local listed property. Thank you very much.
Evan, thank you very much. Always high-level energy coming in, because we know you are passionate about what you do. And we actually spoke a little bit beforehand about the consistency of asset management teams and how your team has been all together from the word go. I mean, all your senior staff. And that also probably speaks to your results. You mostly all periods, first quartile performance. You didn't put up any performance slides, so I'll put it up on your behalf. Thank you very much for that. Quick question from my side. As I mentioned in the introduction, you also manage global property funds. I know you've got a flexible fund as well. We actually make the call in local versus global. But just quickly from our, just to get a sense, because I know global property also had very good valuations at the moment, but your positioning on local property, global property at the moment, which one do you overweight, underweight?
We're still slightly overweight local. We were, at the beginning of the year, we were actually quite aggressively overweight local versus global. But as we stand now, we are only slightly overweight. The reason for that is that obviously there's a lot of volatility around the world, but the global has more entry points which are a little bit more defensive. So you've got a lot of uncertainty, macroeconomic uncertainty, whether driven geopolitics or not. Whereas global markets have things that are disjointed or taken away or not impacted by that. For example, data centers or senior living. So things that are not really, it's not a trend linked to interest rates or anything or global growth, but housing, for example, senior housing is linked more to demographics. So we are starting to take tilts towards healthcare and towards data centers because those are underlying businesses which we think that we can ride through volatile up and downs or Trump-like markets.
Yeah. And both your local and global property funds are on all the big platforms.
Yes.
And, you know, if you look at a lot of your SA general equity funds and multi-asset funds, very few of them, there are some that include property. But I would say, you know, if you want property in your client portfolios, you're actually going to have to bolt it in with a building block fund.
I've learned over the last 22 years that a generalist will not look at property on purpose. They, you know, I remember when the sector was only 10 billion, they used to say, no, Pick and Pay as a standalone is bigger than your whole sector. Why should I waste my time? And their mindset hasn't changed. Pick and Pay is not bigger than the whole sector anymore, but the mindset hasn't changed.
Oh, there you have it. Evan, thank you so much.
Thank you.
Right, we continue with fixed income. First up, we've got Philip Bradford from Portfolio Metrics. You're all very familiar with Philip. Philip, thank you so much for being here today. Thank you.
Thanks, Eugene. Oh, my slide's up. Oh dear, got to go back one. Great, thanks. So my name's Philip Bradford from Portfolio Metrics. As a team, we run the Dynamic Income Fund, which many of you know, but if you don't, I'll touch on it a little bit later. I'm asking the question here today from a South African bond and fixed income perspective, and essentially from a South African perspective. Are we a fallen angel or are we a rising star? And in case you nod off in the next 5 minutes, I'll run it all for you now. So the good news is we are starting to rise again, and this is very positive from a South African perspective. The other good news is it's not fully priced in yet. We've seen quite a lot of improvements, but I'll unpack all of that for you just now, and you can tell me if you disagree with me or not. So what is a fallen angel? Well, a fallen angel is a bond that was once considered safe and high quality, was rated as investment grade, but has since been downgraded to junk or sub-investment grade. We all became familiar with junk nearly 15 years ago now. And this is obviously not a good thing. So as a bond investor, you're borrowing money all the time. As a country, we're investing with different, we're effectively lending money to them. It can be basically the financial situation of the issuer. It could be a company, it could be a government, has worsened significantly. But this is only a bad thing as long as it's not reflected in the price. So what we start to find with some of the fallen angels type bonds is at some point, if they do start turning, they can start to be showing very good yields, as we've seen from South Africa over the last while. And there's been a number of fallen angels over time. We've got Brazil, we've got Indonesia, we've actually got Mexico and Turkey here. We're showing Mexico because they just managed to avoid a downgrade. What tends to happen is you tend to get rising debt, deficits, external imbalances in the economy. You get a governance decline. Does this ring any bells? Rising corruption, political instability. You then start to have a reform stagnation because as the borrowing costs start to go up for a country, it makes it harder to get things done. The government's not functioning efficiently, and you start to basically have a loss of investor confidence. One of the couple of the metrics you start looking at, the one is debt to GDP. Now, what we've got in the little pink square over there right now is 60 to 80% debt to GDP. South Africa right now and at the end of last year was at 77%. And you can see when Brazil was downgraded to junk, they were in our sort of range here. Interestingly, if you look at where Indonesia was when they got downgraded to junk, it was much higher. And Mexico just managed to avoid that. Turkey got downgraded to junk actually when their debt to GDP was quite low. So it's not the only thing you want to look at. Current account deficit is another one. South Africa has actually improved quite a bit in the last number of years. This is kind of your imports versus your exports. We always used to run a much higher current account deficit, so we're falling below that sort of range right now. But you'll see from Turkey as an example, their problems when they got downgraded to junk was more linked to sort of trade accounts and other political problems that they created for themselves. So what is the life cycle of a fallen angel? So what you find is you start off with pre-downgrade stress. This was us in the sort of mid-teens, just before Nenegate and the likes. We started seeing, and it was not too long after Jacob Zuma came into power. We saw weakening fundamentals, governance red flags, rating agencies starting to warn. We then had the downgrade shock. official downgrade, forced selling of your bonds, and your currency goes along with that. And then you see a spike in yield. So as your bond prices fall, you've basically you've gone from being able to borrow at prime -2, and now you're borrowing at prime +4, effectively, if I was going to use a housing bond analogy. Then what happens is you get a market repricing. Basically, you get a squeeze. You've got investors that are forced sellers. You've got ETFs. You've got investors that are not allowed to invest in sub-investment grade anymore, funds, fund managers, etc. And it forces more investors out. So you tend to get a bottom out. Then you start to see a recovery and reform potentially. And to have that recovery and reform, you need policy and fiscal adjustments. You need improving fundamentals. You start to get whispers of upgrades again. And we're seeing that now in South Africa. And you start to see a return of investor confidence. And then you've got two paths, really. You've got the upgrade path, and then you've got the stagnation type path. Now, the question is, which one are we in right now? So from a fallen angel perspective, the stagnation path is really when reforms stall, fundamentals reverse, and then investor confidence evaporates. Now, we've had South Africa's, as I'll show you just now, we're not out of the woods yet. We are seeing some improvements, but what we're finding more is we're moving a little bit more towards this upgrade path. Now, we've been dropped from the A team to the B team to the C team to the D team to the E team, and the market's starting to price us back to the D team again. We're not in the A team again, but things are starting to move in the right direction. And this is the journey that we followed. The initial problems, if you recall, particularly Nenegate was one of the big catalysts for the start of the move towards junk status. But the first downgrades we saw into sub-investment grade was only in 2017, and eventually the final junk status only came in March 2020. So it takes the market quite a long time and the rating agencies quite a long time to adjust to that. And here's the foreign ownership of our bonds. So you can see back here, we were at the foreigners owned 43% of our bonds back just before 2019. When we eventually got downgraded to junk in March 2020, that holding dropped down to 33%. So they owned only 33% of our bonds, and they now currently own about 25% of our bonds. That's R1 trillion, by the way. So it's not like they're not invested in South Africa, but as I'll show you just now, we're starting to see some shoots of that. So the big question is, are they going to continue to just hold the way they are? Or are they going to start picking up some of their exposure to South Africa? And that's very important because as the foreigners start, remember the bond investors are the smart investors. They're the ones that are thinking far in advance. And what they're assessing is South Africa worthy to lend money to? And that starts flowing through to currency and other type metrics at the moment, as I'll show you in a moment. So where are we now? We've got a debt to GDP of 77% right now. We need to get that down to about 60. We've got stagnant growth. We are below 1% GDP growth right now. To really do well, we need to get back to a 3 to 5% growth level. The government, and I'm using GNU, which is such an important development that we've had over the last 18 months, but that needs to put a lid on governance, get the governance right, bring corruption down, political instability, sort that out. And then Operation Vulindlela has been the initiative that's been driven between the Treasury and Ramaphosa directly. They've been doing it since 2020, but some of the traction's only starting to come through now. And that's the big growth reform agenda, which I'll touch on just now, and that brings investor confidence back to the country. So we need economic growth, we need spending to be constrained, and we need to get the debt levels down. We spend about R1 billion a day on interest payments in South Africa here, just paying back debt. So we need to get that cost of borrowing down and the level of debt down. And this reform agenda is very important because the only way you can pay back your debts is if you earn more. We need more tax revenue. If you've got more tax revenue, then you can actually pay back more of your debt. And that's the weakest part of South Africa in this equation, as I'll show you just now, is actually growth and tax revenue. So where are we now and what can change? So just on the estimates on the energy sector reform, if we just get the energy sector right, that can add but just under 1% to 1.3% to GDP. We've already started making movements in this direction, and some of this has been factored in. The second one is freight and logistics. So we need to get that corrected. So it's improving Transnet, getting the logistics right. That can add another 0.5% odd to GDP. And there are some movements in that direction as well. The labor and skills is important as well, getting the education level up. That can also add another 0.5% easily to GDP. The infrastructure and public-private partnerships are important. So this is mobilizing private capital, private involvement into the economy. And this is everything from roads to water to housing. All these challenges we're having right now with water, we've known they were coming 25 years ago. We're working on it at the moment, and there's things like broadband are starting to come through, and that can also add another 0.5% to 1% to the economy. And then regulatory and in the investment climate, like streamline get the paperwork out of the system, get the mining rights right, get the water licenses right, get the spectrum licenses out. Those things alone, which are decisions that can be made by government and treasury, can also add nearly 0.5% to GDP. Now, as I said a little bit earlier, the good news is that the markets here, the yellow line is the credit default swaps, which is essentially like our offshore bonds. Those are pricing us above the green line, which is actually where that's your actual credit rating. So markets now have started, and you're seeing it from the likes of S&P, and they've come out and they've got us on a stable outlook. But what we'll be watching for over the next while is our credit is trading better. So in other words, the market's factoring in, the bond market, the smart market is thinking ahead and saying, hang on a second, we think South Africa is moving in the right direction. South Africa is likely to be removed from the grey list in October, touch wood, but it's still on track for that. And then there's quite a reasonable chance that S&P could upgrade us in the start of 2026 as well. So we're moving in the right directions. And there's a lot of things, as I'll show you just now, that are assisting this. We don't want to give the government credit where credit isn't due. There's a lot of global factors that are helping us right now, which I'll touch on in a moment. And this is the foreign investors now. They are very, very important in our bond markets and our currency markets. And what you're seeing here is South African government bond performance in dollars. They're up about 25% over the last while in dollar terms. And you're starting to see the inflows coming on the back of that. This is global emerging market bond ETFs. So in other words, passive tracking ETFs. Those are adding money to South Africa. South Africa's actually just been, the weighting in that index has just been upgraded as well. And we're seeing strong money coming into our bond market on the back of that. We've been seeing flows out of the JSE for years on the equity side, but we're seeing flows back into the bond market. So that's very, very positive. Importantly as well, we're in a falling rate environment globally. And everyone knows with bonds are like fixed deposits. If you can lock in your fixed deposit rate while interest rates are coming down, that's a good thing. And we're still seeing the likelihood. It's not crazy rate falling from where we are right now, but we're still expecting the Fed to be cutting rates, and there's room for them to cut a little bit more. That takes a lot of pressure off the Reserve Bank. We may not cut rates later on this week, on Thursday, but if we do, we'll be able to do it a little bit further into the future. So what are the factors influencing South African bonds at the moment? There's a lot on this slide, but the most important thing to look at is there's more green than there's red and orange. There's a lot of factors that might, in some markets, be considered negative towards the overall environment, but are actually proving positive for South African bonds. So things like global interest rates and South African interest rates are in our favor. Oil price is on the way down and has got a lid on it in terms of oversupply right now. The dollar's weak. The rand is on the back of that is stronger. Higher precious metal prices are very, very positive, not only in terms of exports, in terms of trade, so gold and platinum and the likes, but also because of additional tax revenue into the fiscus. So a lot of these mining companies are going to be making super profits, and it pushes tax revenue into the system. The inflation target, the lowering of the inflation target from a South African perspective is a very positive move. It probably means we'll keep interest rates a little bit higher, but that's very positive from a rand perspective as well. So that's working in our favor. We're starting to see the green shoots of the economic reform out of Project Vulindlela, and the politics is still positive. We know the GNU is reasonably fragile, but it's a hell of a lot better than anything we could have imagined 18 months ago. There are some uncertainties, and the biggest weakness for us is growth and investment in our economy. At the end of the day, it's about tax revenue coming in, and if the growth is weak, it still puts us, it means we've got to borrow, we've still got to keep our borrowing quite high to fund what goes on in the economy. So the fiscal position, which is effectively your debt and your expenditure, and then again, the global geopolitical environment is also a little bit uncertain at this stage. But overall, there's more greens than reds and oranges, and it's moving, the tide is moving a little bit in our favor from that perspective. But most importantly, and this is, things are moving quite quickly. Bonds have been rallying a little bit in the last while. What we're showing here is where the yields were on the All Bond Index during Lady Russia and the energy crisis, the COVID crash, Nenegate. And this was just at the end of August there. The bonds were actually still above where they were during Nenegate. Now, during Nenegate, we were falling off a cliff. We're clawing our way back on towards investment grade again, hopefully in the future. And the bond yields are still factoring very, very high yields. So it's positive from that perspective. Some of the yields, Evan, by the way, if you're still here, you were saying you needed a 10% 10-year rate. It's coming close to 9% now. So very positive for your property stocks, by the way. So we've seen the foreigners started factoring in a lower yield, but we're still able to lock in at about 10.4% on effectively a 20-year fixed deposit today. Interestingly, those bond yields are back now where we were just before the Ukraine invasion. So just think about that. But the tide is moving nicely in our favor. And this kind of gives you an indication that typically if you've bought bonds around this level, and this is the All Bond Index, and Dynamic Income Fund, we are very much more dynamic around our exposure, and we hold more of some of the longer dated bonds, which are a bit higher than that. But typically, if you've bought bonds around this level, your next 2-year return has been around 10%. We actually took advantage in April. This is where we were on Liberation Day, and the GNU was potentially going to break down. We were able to buy bonds around 12% actually just around that period, and we were able to lock in yields at nice high levels. A lot of that's retraced now, and we have reduced some of the bond exposure. But the bottom line is, when interest rates are coming down, you want to lock in some of your fixed rates. So here's our scenarios from over the next 12 months. The yield on the funds now on Dynamic Income Fund is 10.7 is the gross yield. If we have a falling rate environment and things go nicely from here, we should get closer to about 100 basis points, a rally on that front, which gets you about a 13%. But most importantly, we don't plan for good outcomes. If things go wrong, if someone bombs someone around the world and something goes wrong, a bad 12 months would probably be close to 8% from here. And we've seen that over time. This is where we were a year ago. And we know that 12 months later, just before the election, we were up about 18%. So over time, during much worse times than we're seeing right now, we've managed to do just under 4% ahead of the peers per year over nearly just over a decade now. Over the last 12 months, we're up to about 13% or so. But importantly, most of the good track record in the past came in an environment where bonds were selling off and interest rates were going up. We're now into a falling rate environment. And crazily enough, if you look at it over the last just over 10 years now, actually done nearly 180%, and actually including the last couple of days. And importantly, that's miles ahead of the bond market and the equity market, and actually that's about 62% ahead of the peers cumulatively over that time. And the irony is multi-asset high equity is over here somewhere, which actually hasn't been that great a return. So in an environment that was bad for bonds, we've managed to squeak out very decent returns and better than most anything else pretty much you could have done. And we believe that going forward from here in this falling rate environment, the environment is actually more positive for us than it was over the last few years. Thanks very much.
I want to check quickly. Any questions for Philip? Yeah, I've got one question very quickly, Philip. Sorry. If I look at your fund over the past 24 months, you've always been very active switching between floating and fixed rate notes. On average, your duration also ran a little bit higher, but it showed in your numbers why. You explained that very well. But sometimes we get a statement being made because your duration runs a bit higher that you are a more aggressive fund manager. Is that statement right?
So the good thing is the government bonds are the most liquid and the most credit-worthy bonds in the country. And the credit bonds, which are giving you a lower yield at the moment, are riskier because you're lending someone money. So we've actually reduced the duration quite significantly over the last year or so. So we're down to about 3.5 years duration. What does that really mean? It means we're holding a lot less bonds than we did a while ago. But the most important thing is the yield here. We've got a yield of just under 11% still, and that's your best indicator of the forward return. But the story's changed here. Credit is expensive, so corporate-type bonds, they're not giving us the yields that you were getting a number of years ago. And the government bonds, which ironically are the safest bonds, they're the most credit-worthy bonds, are still giving us yields of over 10.5% at the moment. So ironically, yeah, we're actually in a lower risk credit perspective probably than we could be. And if we wanted to reduce the volatility, we would just be taking much more credit risk.
Exactly that. Thank you very much. Thanks. That's fine. Keep it. Yeah. Right. Next up, we've got Rafi from Sasfin Asset Management. Rafi, I just want to check there you are. Sorry, I'm looking in the wrong direction. Thank you so much for being here.
Thank you.
Appreciate your time.
There we go. Afternoon, everyone. My name is Rafi Rutstein. Don't know where that is. Oh, there we go. I'm one of the portfolio managers at Sasfin Asset Managers, and I'm sure you're all familiar with Arno Lorenz, who's our Chief Investment Officer, who manages the funds that we'll be focusing on, which is primarily our flexible income fund and a little bit our high yield fund. But when you're preparing these presentations, and BCI really wants us to have these in weeks and weeks in advance, it's always hard to try and find something that's topical, that's relevant, and that will still be relevant 3 weeks later, especially in this ever-changing environment that we have in South Africa. So I thought something that's really been top of mind over the last while is the SARB's push to change our inflation target a little bit lower to 3%. And I thought maybe to focus a little bit, therefore, on inflation and what the prospects are, just as one lever in fixed income as to what that impact and outlook will be. So I'll start off with something personal. This is actually some cookbooks that my grandmother, who was a famous chef, at least in the Jewish community in South Africa, happens to have published in 3 different languages. I don't know if any of you in the audience might have known her. For 3 or 4 decades, she was probably the go-to caterer in our community, and happens to be that when she retired, I think she was the first woman who was ever admitted into the British Chefs Association. I never even know what it is, but the first female ever to be admitted into that prestigious organization and association. And when she retired, having managed, together with my grandfather, an extremely successful catering business, she retired a millionaire in dollars. Even when my grandfather passed away now almost 20 years ago, they still had more than $1 million in assets and savings. And just because of the cost of inflation, and she should live and be well, she's already well into her 90s, with advancing health issues, the need for full-time care, needing to live in an assisted facility for elderly, you know, that savings has dwindled to the point where us as a family are now considering where to next and how much does she still have left of those savings. And so much of what we do in asset management and so much of our purpose with responsibility, with taking appropriate risks at the appropriate time, is to try and ensure that our clients, as they age and as they get older, can save for retirement and live with dignity into their old age. And as longevity increases, this is becoming more and more of a challenge, that we have to make sure that we can grow our clients' wealth at above inflation. And this is just random things. How impactful is inflation? So I don't know if anyone can see some of those prices, but I happen to find, thanks to Google, a few ads from 1980. I mean, it's amazing how resilient some of the brands are that we have in South Africa. You've got your All Gold, your Recoffee, your Sunlight Liquid, but can you imagine paying less than R1 for a bottle of dishwashing liquid? And now today, the same thing, and this is the specials page. On special, you're looking at something that just from then, cumulatively, is 4,000% more expensive on average than what it was in 1980, which is an increase of 9% per year, effectively in terms of the cost of living on a day-to-day basis. Similarly, the cost of cars, if you look at a somewhat entry level, not even the entry level, but one of that go-to sedan as an entry-level car in South Africa, which once cost you 100,000 Rand, is now going to cost you over R500,000 for an equivalent vehicle. Again, an increase in price of 8% per year on average. And one of the things, as the SARB flagged in that working paper that they did in terms of the benefit of reducing our inflation target, is that when your cost of manufacturing and your cost of goods increases so much, if you actually look at it, the cost of inflation or the increase in inflation in terms of how much goods have gone up has actually gone up more than the currency has depreciated in that same period of time. And as a result, us as a competitive manufacturer and exporter of these goods is actually becoming less and less and less. because at the end of the day, it's becoming more and more and more expensive because of the labor costs and the input costs and the electricity costs to manufacture these same goods. So that, as I heard from NAMSA earlier in the year, Morocco is soon going, or has already, I haven't actually looked recently, Morocco will soon overtake South Africa as the largest exporter of vehicles on the continent. And because we're just becoming less and less competitive, even when we can produce and manufacture, but it's becoming too expensive that it's not even worthwhile, even with our currency as weak as it is, for people to choose us as a preferred manufacturer and exporter. We know that inflation has trended lower, certainly over the last period since 2021, and really as inflation, as you can see, that it's trending down there at that 3%, it has ticked up a little bit, really was the impetus for the SARB to say that now is the time and the opportunity that maybe we should shift. And we know that they announced, even without all of the consultation and maybe commitment from their other partners in terms of National Treasury and the Finance Minister, that now is the time to try and make that move because inflation has come down so much. And the question, I guess, that we wanted to ask or pose is how likely is it, or how quickly is it, that the SARB will be able to actually achieve this target? I mean, in the meantime, we're still seeing, when it comes to wage negotiations, labor negotiations, that people are still, as their first ask, is to request 8, 9, 10%. And until we're going to see that your go-to in terms of how much of an increase you need for the next year is going to be closer to that 3% level, it probably is going to be very hard to achieve a 3% target. When NERSA comes around and says, I'm sorry, we forgot, we actually needed to give you an extra 54 billion, and we'll just pass that on to the consumer, and administered prices are so high, how challenging and how easy will it be for the SARB to reset those expectations and actually, yes, get us to that 3%? So what I've shown over here is the last time the SARB announced that there was going to be a reduction in our inflation target from that 3 to 6 band and explicitly target 4.5%, it took us approximately 2.5 years for those expectations and perceptions out there to actually accept that 4% is the correct level of inflation in our economy. And I guess now the question is, how long will it take going forward? The SARB maintains that they've achieved so much credibility because of this 2.5-year period to get to 4.5%, that before you know it, it should just take a year. But the reality is that until these things pass through and actually are achieved, maybe it does take a year and a half, 2 years, 3 years. And part of what Phil was saying, that actually bodes extremely well for fixed income, as I'll touch on a bit more. 29th of May this year is when the SARB actually announced that they were reducing the inflation targets. I've just shown over here how much have bond yields compressed since then, since that announcement was made. And this is just the period between the end of May and the 31st of August. As of today, the all bond index has returned 13% or thereabout. 9% of that return has been generated since the 29th of May. So what I'm pointing out over here, these pink lines, is that you can see up until the 29th of May, the front end of the curve, because we were getting some rate cuts coming through, were a little bit stronger. But across the curve, you're really seeing, since that inflation target was implemented by the SARB, that there's really been quite an aggressive shift downwards of yields on our curve that's resulted in tremendous capital gains for all those who were lucky enough to be invested during that period. And so going forward, what do we expect? This before May, if you would have looked at the same chart, the expectation was that the interest rate cycle and the cutting cycle would bottom out at 7%. At this stage, the SARB is saying that if your neutral interest rate is 2 to 2.5% above inflation, that we really should be able to get down to 6%, if not lower. At least now the market is beginning over the next year and a half or so, or 2 years, to factor in that we'll at least get 2 more interest rate cuts over the next while. Maybe not this week on Thursday when they meet again. I guess it might depend on what the Fed does. But certainly going forward, there is certainly scope. And as the SARB trends towards that 3% target, that we should be able to see that interest rates should come down meaningfully closer towards that 6% level. And doing like a back of the matchbox calculation, assuming that that would be correct, as Phil said, not everything is still priced in. There's a lot of gains that there are still to be had in the fixed income space. There's a lot of political, economic reform. I don't know if any of you have seen, Black Leadership South Africa has created a reform tracker on their website where they look at across the spectrum, economic reform, governance reforms, judicial reforms in the country, and they pointed out in their last quarterly newsletter that the pace of those reforms are at their highest that they've been in quite a long time in terms of the momentum of those reforms taking place in the economy. And as Phil pointed out correctly, that bodes exceptionally well that probably towards middle to end of next year, we'll be beginning to talk about whispers of ratings upgrades and slowly, maybe, hopefully, taking that path towards or getting up out of that junk status. And if that's the case, all I've done is say, if we would look and say that we'll have another 0.5% reduction in bond yields for the entire all bond index, at this point, over the next year, what will your return be? And that should be around 12%. If we can even have 1.25% of a reduction in yields over that same period, that gives you a return of 17%. And our argument is that if the SARB, geopolitics is what it is, and there's so many other factors out there that we can't control. But the GNU has been a godsend and a blessing that none of us could have expected, and yet we are seeing these reforms take hold, and the positivity around South Africa picking up and increasing exponentially more than we could have ever imagined. Vulindlela's contributing significantly. Reforms across municipalities seem to be picking up momentum, hopefully. Emphasis on water infrastructure, logistics, and the like. The deregulation of the electricity sector, and hopefully that then follows through into logistics as well and help Transnet recover. All of these are positive tailwinds and momentum for the fixed income space. And because of that, 17%, so these are based on numbers that a lot of analysts have spoken about, where you'll see a re-rating of our curve downwards, 0.5 to 1%, which I think speaks to the fact that especially if it's going to take 2-3 years for the SARB to achieve this target, we should expect, all else being equal, that we're kind of in the throes of a sustained bull market in bonds that should be able to achieve exceptional returns. At Sasfin, just to touch briefly, we have 2 flagship funds, and in the context of this presentation, I really want to focus on our flexible income fund, where we try and achieve bond-like returns with less volatility. We happen to also have a high yield fund, which is a bit of a misnomer, but really it's a stable income, enhanced income, enhanced cash type of product, which gives you about 2% above market, above money market, typical type of funds. But the point is this, and this I just want to focus on, as we come back to this inflation story and the need to invest in such a way that we're able to achieve above inflation returns for our clients, just to point out that our flexible income fund, because it benefits from having those capital gains and doesn't just accrue interest, but does, because it's invested in fixed bonds, is able to achieve capital gains on top of it. Our high yield fund, which is really just accruing income at a high level on a monthly basis, both of those funds have well outperformed and exceeded returns relative to inflation. So that 3.5 was the last inflation print. But over the last year, you've gotten, even in our high yield, which is really a conservative, well-diversified income fund effectively, has given you 6% real returns out of this asset class. And if you're prepared to take that little bit extra risk, 7.5% real returns, which is just fabulous if you're investing for the future and for your clients. And to point out that, like this is one of the slides, we try and be exceptionally transparent in terms of the risks that we take within our portfolio. And, sometimes one can maybe make speculative bets or try and do things that are a little bit risky. But one of the guiding principles in terms of how we manage money, and certainly with Arno at the helm, and a strong credit risk department with Ringatani and Blovo as our head of credit risk, and which everything that we invest in has to go through that credit risk process, really speaks to the fact that, as you can see, and this is the current makeup of our fund, that we're sitting in a fund where almost 80% of the fund is invested in AAA-rated instruments on a look-through basis, which is a very high-quality fund. And even that A-, as you can see, is the bottom of that spectrum in terms of the credit risk that's in the fund, just on a credit rating perspective. And there's numerous other slides that we show that speak to this, but that's generally the theme across all of our funds, that it's well diversified and very, very consistently investing in high quality credit in order to achieve those returns. And as a result, cumulatively, the fund, since its inception, as we just show over here, which is this darker blue line coming up over here, that it has well outperformed peers, benchmark, the all bond index. As an actively managed fund, we really do move and shift the composition of the fund through time and through cycles in order to try and achieve the best risk-adjusted returns that we can. And amazingly, since the fund's inception just over 10 years ago, this fund currently ranks as the top performing fund in the multi-asset income category of the market. And that's just another idea just to show you that same theme, that the fund is able to achieve those higher returns at less risk. And just another slide, just that I'll finish with this, just as I see time is running down, but that the capture profile, which is how much or how actively managed is your fund relative to a benchmark, just to point out that when it comes to upside return and capturing the upside that is earned in the all bond index, when we compare our fund to the all bond index, 80% we are able to capture 80% of the upside, whereas on the downside, we only pick up about 10%. And that dynamic, because of the active nature of how we manage the fund, is really what drives those positive returns through the cycle. I'll pause over here.
Thanks, Rafi.
There you go.
Good to know a little bit more about your family. I'm definitely going to look for that cookbook. Maybe you've got a copy for me and I'll buy it from you. Very quick question, and I mean, inflation-linked bonds have been very topical for the past 18 months. Entry points for inflation-linked bonds, a lot of people seem to get that wrong. Inflation-linked bonds in your funds, do you use it? Is this the time to add more?
So it is a difficult asset class. Typically what you find is that inflation-linked bonds rally after nominal bonds have already rallied. So, I mean, currently we did, going into with all of the geopolitical risk that we had, we did allocate some of our fund to about 3.5%, 4% to shorter dated inflation-linked bonds. Currently, because of just seeing how much nominal bonds have rallied, and actually, I don't actually have to check the numbers, but I know over August, linkers outperformed nominals, if I'm not mistaken. Certainly July it was the case, that we have added a little bit of linkers into our fund at the moment, and hope to capitalize on the capital gains that will come from that as the curve shifts lower and inflation begins getting priced out of the market.
I will leave that in your capable hands. I'm not going to try to time that, and I'll give it to you.
Thank you.
Thank you so much for your time. We really appreciate it. Right, last up for our fixed income panel, Conrad Wood, a man that needs very little introduction. Conrad, thank you so much for joining us this afternoon. Good to have you here. Thank you.
Thanks so much. Thanks, Eugene. Thanks to BCI for the opportunity, and to you guys for taking time out of your busy schedules. I think try something a little bit different today. I think there's enough sort of coverage of the granularity of fixed income markets and the bottom up and the next year's 6 months forecast return. So I'm going to sort of remove us from that noise. I find managing money in this environment, if you listen to all the headlines and you get caught in the daily ups and downs, you feel like you're in a washing machine when you're managing money. So I'm going to go really top down and go to 10,000 feet today and look at some what we call macro Ds that are coming down the tunnel over the next 5 years that I think we should all be aware of. They're not going to change portfolios tomorrow. They're not going to change the way we act immediately, but it's that classic, if you don't pay attention to them, it's the frog being boiled in hot water. And by the time you realize that they're upon us, it might be a little bit too late. So the first D, demographics. And I'm part of this. World's getting older, unfortunately. This chart shows you on the left-hand side a map of the world, and it shows the birth rate per, I don't even know if you can say birth rate per woman anymore. The birth rate per person. So birth rate per woman and blue are more than 2 children per woman. And I don't know, I've seen this chart maybe 10 years ago, the whole world was blue. It's now become progressively purple. And purple is where you dip below 2 children per woman. And it's emerging markets, it's developed world, it's Latin America, it's Asia, the whole bang shoot. The world's having less babies. I see Africa is do it for your country, sort of the motto is still going strong there. But the world's getting older and therefore more dependent. On the right-hand side, that chart shows you the number of working age, productive, contributing to growth people that are supporting the number of old tuppies that are not adding much value to the economy anymore. And you can just see, it's not a very clear chart, but the progression starts 1997, the top dots, it comes down to current, and the dark dots are where we'll be in the year 2050. And if you look at the extreme right-hand column, we have come from 10 working class productive people supporting one old-timer, and we will be down to, I think it's 3.9, if I remember there, by 2050, playing a supportive role, earning taxes, being productive to support someone who's not contributing to the system. So an older world with much more dependency is something that is coming down the tunnel. The second D, democratization. And I'm actually going to go, or lack thereof. And it's not really the opposite of democratization, but I wanted to talk about here is populism. The rise of populism in the world. Those 2 panels show you on the left-hand side, in a sample of 61 countries, in the year 2000, less than 5% of those countries had populist governments in place. Currently, it's got up to 25% of those 61 countries have populist governments in place. And on the right-hand panel, you can see, not very clearly again, but the green bars show you in a sample set, countries where the populace is happy with the outcomes of democracy, versus in the blue bars, those who are dissatisfied with outcomes of democracy. And you can see the blue bars are starting to dominate the green bars, and in some cases become quite meaningful in terms of dissatisfaction with the outcomes of democracy. And populism is not just Venezuela or Argentina anymore. We are moving to the leader of the first world, America. And if you just have a look at what's gone on there, it's almost unimaginable. And that picture just sort of said 1,000 words to me. The Trump domineering, tall, big in stature, almost bullying. And there's the Fed chairman. I don't know much about psychoanalysis, but I don't think that posture is one of confidence or domineering. He looks absolutely coward. And I mean, this is happening in America. It's well documented on the K-shaped recovery. So I don't know the proportion, but a lot of America is doing incredibly well, and a lot of America is doing incredibly poorly, and hence the notion of the K-shaped recovery. And Trump is preying on this, and this is being exacerbated by social media and the polarism that's developing inside that economy. And if you just have a look at some of the things that are coming through in this battle of the people versus elites. And the irony is Trump is one of the elites who's now representing the people. But things like anti-immigration, things like trying to bring back suboptimal manufacturing industries, messing with the electoral system, increasing of military, attacks on established institutions. These are all populist traits that are prevalent in what was meant to be one of the world's biggest and most stable democracies. The third D, so after demographics, after democratization, is deglobalization. Now, you've seen this emanate in America as well. This whole, pulling apart of the world, taking it into silos, taking it into isolationism. After we've just spent 3 decades of bringing it all together and benefiting from the rise in growth and the fall in inflation that globalization brings, we've got America pulling us in the opposite way under their America First sort of narrative, trying to reestablish domestic manufacturing capacity, trying to secure their supply chains, trying to reduce this burden of them being sort of the defender of the world from a military perspective. And in the process, really alienating their allies. And this chart shows you, again, in a quite substantial research poll, the percentage of countries who have a favorable opinion of the US has gone from a peak of about 63 in this country group to 35, call it halved. And the group of countries that have a favorable opinion of China, yes, not a material rise, but anyway, up from 24 to 33, I think. And this is a difference in approach. China is courting other countries. America is bashing them on the head with a stick as this world moves apart. The fourth D, de-dollarization. And a lot has been made of this. Is the US dollar here to stay? Is it going to be the dominant currency in the world still? What's going to happen? Should we exit? Chart on the left shows you the percentage of global foreign exchange reserves and gold that is in US dollars. That's gone from a peak of just under 75% down to the current 60%. So 15% of global forex reserves has moved out of US dollar denominated assets. And that has corresponded quite nicely with the rise in gold. So gold is one of the places where this money is going. There are others as well, but gold is quite prevalent. So is it the end of the dollar? Is it doomed? The chart on the right would suggest not. That shows you the volume of all forex transactions in the world that are still dollar-based, and that's actually going up quite significantly. And 88% of all foreign exchange transactions are still in dollars globally, which suggests that the exit from the dollar is a cyclical sort of phenomenon that's happening now, and it's not quite yet a structural or permanent phenomenon. And the reason it's happening, in our view, is that look at the inflows that came into America over the last sort of 20 years, per asset class, and it just went absolutely, parabolic as the US economy outperformed, as the dollar was strong, and as there were increasingly less alternatives to invest in anywhere else. And that at a time now where those foundations are shaky and the policy uncertainty is elevated, just simply some of that money is likely to come loose and just reverse. And the chart on the right-hand side is meant to give an indication of that. Looking across a few jurisdictions, the bars show you when a foreign country is invested in US dollars, how much of that have they traditionally hedged back into their home currency? So I like the US asset, I want to be in Meta, or I want to be in Google, but I don't want the dollar exposure, I want that in Swiss francs or Danish crowns. How much is hedged? And you can see the orange dots show you where those hedge ratios are currently versus the blue dots, which are the 10-year average, versus the top of the black line, which is the maximum it's been over time, suggesting that if the rest of the world starts to want to hedge their dollar exposures, there is a fair amount of dollar outflows that will still come from the US, which will give the cyclical deterioration of the dollar significantly more momentum. And you see US Treasury holdings on the left there, both private and official. The reduction in the foreign ownership of US Treasury holdings has come down quite significantly. But noticeable, it's not just been since Trump came in. This started a long, long time ago, where there was active unwinding of US Treasuries holdings by foreigners. And the chart on the right is work done by JP Morgan that suggests that for every 1% of GDP that foreigners take out of the US bond market, that has a 30 basis point upward impact on US Treasury yields. And so we think it's quite conceivable that about 3% of GDP could leave the US bond market on these hedging type strategies. And if this analysis is right, that would equate to 150 basis points of upward move in US bond yields. Now, we might have had some of that already. US bonds have had a terrible sort of 2.5 years in terms of returns and upward moves in yields. But this theme of de-dollarization, particularly the cyclical part of it, is very much entrenched in our view and could put pressure on the dollar and on US bonds. The last D, deficits and debt, which is abundant, and everyone's spoken about that. A lot's been said about it. The US particularly, and there are many other countries in the world, are running budget deficits the size of which have traditionally been run in wartime, when you're building military equipment, when you're putting every single cent in the economy to work in terms of defending yourself, the budget deficits are in peacetime the same size as wartime deficits, and the US needs to borrow significantly to keep that party going and to keep that sort of merry-go-round going around. In fact, over the next 5 years, if their deficit gets to 8%, which we think it's likely to do, they would need to borrow between $3 to $5 trillion worth of debt in their local bond market. So those are the 5 Ds, and I'm not going to go through this all, but if you look at the consequences of those Ds, and you look at the impact thereof on US bonds, it's almost unequivocally bad for the US bond market. So it's more spending, it's more borrowing, it's more dependency on the government, it's more support, it's less growth, it's higher inflation, it's less productivity. Now, I mentioned the word productivity, so I'm not saying these Ds are the only exclusive macro drivers. We are in the middle of this CapEx AI boom that could well provide a productivity offset of meaningful proportions. But if you look at just in isolation here, all of those lead to higher US bond yields, steeper yield curves, and a widening of US risk premia. And you see that coming through in US Treasury bonds. The chart on the right shows you the widening of the risk premia embedded in US Treasury yields over the last sort of 5 years or so. And it's gone from being as ridiculous as minus 50 to minus 100 basis points when the Fed was buying all the US government bonds themselves and compressing yields through their financial repression sort of policies. It's gone from minus 100 all the way to approaching plus 100. A complete repricing or derating of risk inside US government bond yields. And this brings us to the 6th D. So bonus, parcella one for you. And this is like turkeys voting for Christmas as a fixed income portfolio manager. I should not be saying this up here. But if you look at the left-hand chart shows your holdings of US government bonds or market cap of US government bonds. It is up 7-fold in the last 20 years. The market cap of US bonds has increased by 20 times. And this is not because its value is going up. This is because they're creating more of them. The currency that they are paying you your interest in is also up 7 times. The US dollar money supply is on the right. You're holding a piece of paper that has increased in supply by 7 times, and you're being paid in a currency that has increased in supply by 7 times. You are getting debased at a rapid rate of knots. And this chart shows you the debasement or the devaluation of the dollar over the last 100 years. At the start, 25 US dollars is equivalent to $1 US today. In 2020 alone, they created 20% of all US dollars ever in circulation during that COVID period. And so as a holder of US debt, you are getting poorer and poorer and poorer as you sit there. And this has changed the characteristics of US bonds. They were pretty much, as you went, they followed the dollar, hand in glove, and you can see the complete dislocation. And I apologize for typos. That should read 2025, 2024. It is current. There's been a complete dislocation in that market. The dollar is weak, and US bonds are weak. They've completely separated themselves. The dollar's tanked 12%, and US bonds have gone up to 4.5%. They've completely decoupled. And the market is asking the question, as are we, what is the job of US bonds going forward? And the chart on the right shows you that the correlation or the diversification benefit you got from US bonds has flipped completely. They used to be a good hedge in a portfolio. When the S&P tanked, US bonds would do well, and that's how you got your protection in the classic 60-40 portfolio. The correlation with US equity has just flipped positive in the last couple of years. So when equities tank, bonds tank. And when equities rally, bonds don't rally, which is not an awesome characteristic to have as the global diversifier. So I'm going to leave it with, well, who cares? What about South African bonds, which is the dominant asset in the local fixed income portfolios? And traditionally, there's quite a strong correlation between US bonds and South African bonds. The line is upward sloping. There's some idiosyncratic, times when they diverge, but generally higher US yields bad for South African bonds is the way we've sort of thought about it, using historical correlations. But what you've seen during this period where US bonds have come under this pressure and derated and widening risk premium is that South African bond yields of all the things you would not have expected to do this, have compressed by 200 basis points relative to US bonds. So in the time when US bonds have done really, really poorly, South African bonds have compressed and done really, really well. And I'll leave you with an unanswered question, because I'm still trying to answer it, is are we entering an era now where you can have emerging market assets behave differently to how they used to behave against US bonds? And are US bonds really the global sort of risk-free bastion that they have been, that we've based our valuation criteria on for so long when looking at South African bonds? And the answer may just be that they're not anymore, given these 5 Ds, but I guess time will tell as we move along. Thank you very much, guys.
Conrad, very insightful indeed. And recently we've seen how some managers, if they want to hedge out some of their global equity, they actually buy US bonds. Are you now telling us if you want to hedge out global equity, buy SA bonds?
Or Brazil, or Mexico, or any of the other EMs. These correlations are broken, and it's going to lead to interesting portfolio construction decisions going forward.
Very interesting indeed. Conrad, thank you so much.
Thanks, Eugene. Thank you.
Right, for our last session for the day on hedge funds, Edrich Jansen. Edrich, thank you so much for being here. Jy het gesê jy gaan die helfte van die aanbieding in Afrikaans doen.
Inderdaad, ja.
Dis fantasties. Ons sien baie uit daarna. Okay, we're going to look at hedge funds and how it can diversify client portfolios. We've had a couple of hedge fund webinars so far. I think we had about 5 or 6. Edrich also been on one of his webinars. I think it is becoming a lot more popular, hedge funds in client portfolios, to understand how it can potentially mitigate risk as well and add to value for clients over time. But I'm not going to spoil the fun. Edrich, thank you so much.
Thanks very much, Eugene. I feel like I need a major introduction because probably no one in this room, apart from a handful of people, has ever seen my face. So just a brief background before I tell you who PTA is. I actually played professional golf before I went to university. And just a fun fact before I get there, this is the first time I'm mic'd up standing on stage in front of a group of people since my high school musical. So after that, I went to play some golf, chased a little white ball down the fairway, finally saw the light, and the ripe old age of 30 years old, I went to the University of Pretoria, just around the corner, and I studied investment management. And I graduated with a master's degree in behavioral finance, and obtained a postgraduate diploma in financial planning, as I'm sure most of you have as well. So, and then a little bit about PTA. We actually cut our teeth at 361. That's where Jean-Pierre, my colleague, he was at 361 for 6 years. And in 2016, he wanted to start his own thing. And we launched 3 funds. It's obviously difficult to start a business. And we went into a joint venture with Fairtree, and we launched the 3 funds in 2016, and they helped us go through the J-curve. And in 2019, the 14th of June, we became a standalone business, and Protea Capital Management was born. So I don't know how many people have heard of us, but hopefully you can remember the name after today. And I was listening to Zanele, which was a fantastic presentation. I really enjoyed the presentation, and she referred to 361 having 16 billion as a nimble. I think that will make us contortionists because we are very far from that. We manage just over R1 billion at the moment, and the adoption of hedge funds obviously have been very slow, even though it's been classified as unit trust for a decade now. I think the last 2-3 years, hedge funds have become more prominent in client portfolios. We've experienced it. We see it as well. It's not even, it's on all major platforms. It's available. It's daily price. So it's really accessible. Now it's just a question of, should I use it or not? And I think a lot of people here hopefully are using hedge funds. And after the next few minutes, hopefully those who do not can see the value add. So my presentation today, even though I'm talking about sequence risk, or that is the title, I think that is the overarching idea of today is to make you see why you should include it. And sequence risk is definitely one of those. If your client retires tomorrow and the market falls by 30%, he's in deep trouble. And that is where hedge funds can play a vital role. So I'm going to talk about what a hedge fund is because I don't want to assume everyone knows what a hedge fund is, and there are many different hedge funds. The role of them in the portfolio, the drawdowns and sequence risk, and market outlook and insights. So the first point I want to try and make is hedge funds are not homogeneous. That is just a fancy word for all the Afrikaans people. They're not all the same. There are many different kinds of hedge funds, just like there are traditional unit trusts. There are equity hedge funds. That's where we operate. That's the vanilla flavor of hedge funds, equity, long, short. But you also get fixed income hedge fund, multi-strategy, market neutral, etc. But then there's another subdivision. You get hedge funds that behave in different ways. You get hedge funds that are seen as return enhancing, which typically they will rise even more when the market goes up, and conversely they'll fall even more when the market goes down. And that's not where we operate. We, in the risk diversifying category, we see ourselves as risk diversifiers. So typically when the market runs hard, we would lag, but when the market falls, we would hopefully fall a lot more. And the next few slides I've shown by example, using one of our funds, what has happened. Obviously, there's a common denominator, which is leverage. And when people hear the word leverage, they become very nervous. And hedge funds are perceived to be very risky. There are still some people that think if I invest in a hedge fund, I'm going to lose all my money. Or if I don't get 10% per month, then this is not working. And it couldn't be further from the truth. And there's also some people think hedge funds managers are cowboys. I think those people just watched Billions too much, the series, because, as you know, most people here presented managers started off as hedge fund, and the hedge fund managers themselves are more than competent, very responsible, and most of the time their own money are invested in the fund. The majority of their own wealth are invested in their own funds, and they give everyone else the opportunity to go along for the wealth creation journey. Just a few more bullet points. I promise there are a few pictures after this. It's hedge funds, the role they can play in a portfolio. It's a bi-directional investment strategy, meaning that we can obviously participate on the upside, but when markets fall, we can also make money, or at least protect when we don't make money. And the reason why is because we have additional tools to traditional fund managers. And these include shorting shares or using option structures or futures or pair trades or whatever. Those are the additional tools that we use to manage the risk. And broadly, it's a diversification as an asset class. So if you include a hedge fund, you diversify the person's portfolio because there's usually a much lower correlation to markets than traditional unit trusts. And I'm definitely not dissing traditional unit trusts. There's a place for all of this in a portfolio. This is not a replacement. This is supposed to be a complement to all those traditional unit trusts. But I want to really focus, and the rest of the presentation will focus on the next 3 bullet points. The ability to limit deep drawdowns, the potential for superior risk-adjusted returns. That is really where the rubber hits the road, the risk-adjusted returns. And by doing that, you aim to reduce the client's sequence risk. So what I'm trying to show here is what the fund, and I'm using our fund as an example of what happened in the past 9 years when the market rose, bull months, and when the market fell, the bear months. I didn't include any kangaroo months. It's the first time I heard that term today. But in the months when the index was positive, 61 months out of the last 108 months, the fund managed to capture 1.6%. So it looks like a little compared to what the FTSE Developed World Index did. But more importantly, I want you to focus on the bar chart next to it, the bear months. So 47 months out of the last 108 months were negative. And the fund's returns, or the average return for the fund was 0.17%. That is a lot less than minus 3%, and that is what the market gave you when it was negative. Then I checked what did it do against our local market. Again, the 62 months when it was up, the fund's average return was up 1.2%. Doesn't seem like a lot, but when you look at the down months, and there were 46 out of the last 108 months were negative. And on average, those months were negative by 3%. The fund did not only protect, it actually delivered a positive return on average in those same months. And I think that is alone enough reason to consider including hedge funds. It's not just protecting, it can actually add a return. So the message of this slide is capturing the ups, but also cushioning the downs. Then I dug a little deeper, and I wanted to look at all the bad times, because that is inevitable. The bearish months of the all share and the bearish months of the developed world index. And basically half of the time, 44% of the time when the developed market index was down, the fund delivered a positive return, a monthly return. And on the all share, even better. More than half of the time, the fund was positive. So what does it mean for your client? If you had a client that was invested in the fund and the market was down, half of the time, he would have received a positive return. That is impossible to do with a long-only equity fund that is following a benchmark. It is impossible that there would have been a positive month. So all of you would have seen the slide, the 10 worst months or the 10 best months. If you exclude the best 10 months over a long period, we've seen the graph, you would have done a lot worse than just the index. But obviously, if you take out the worst 10 months, you would do a lot better. That's just common sense. So I was interested to see, and I did a lot of this analysis for the first time for this presentation, and I'm invested in this own fund. So I was positively surprised that I actually could show this. And as you can see, there were some deep drawdowns. This is the worst 10 months in the last 9 years for the developed world index. And it ranges from -8.5 to -4.4. And the fund managed to not just deliver a lot less downside, so a lot more downside protection, but it was up 4 of those months. So similarly, on the all share, compared to the all share index, these are drawdowns of 12% per month, the worst month, to 4%, 12 to 4%. The fund delivered a lot less or more downside risk, didn't fall as much, and 3 times it was actually positive. The last slide I wanted to focus on the drawdowns is when I zoom out and I look longer term. The worst month the fund has ever had, the lowest rolling 12 months the fund has ever had, and the largest cumulative drawdown the fund has had. So again, if you just look at the largest cumulative drawdown on the far right, it fell 8.2%. That's the deepest drawdown the fund has experienced in the last 9 years. And this is obviously through a lot of volatility. It's compared to 19 and 22% for the index, the ALSI and the FTSE Developed World Index. And I really think if it hasn't resonated yet, the message here obviously is if you fall 10%, you need 11% to come back. If you fall 30%, you need 50%. If you fall 50%, you need 100%. There was a slide earlier this morning that I saw, and again, I'm not dissing anyone, but when you experience a drawdown of 50%, the chances of investors, and you would know, staying invested is really hard. It's just the behavioral, economic finance of it. We're all human. We all panic. And if you can limit those drawdowns, not only is it got a quicker recovery period, but you prevent your clients and yourselves from making mistakes, behavioral mistakes that shoot yourself in the foot. So it's one thing to protect on the downside, but what if ultimately people want to make money? They want to capture the upside. Now have we done on the upside? The question is, did we, by protecting on the downside, miss out on the upside? And the answer is no. The short answer is no. This is how the fund has performed over the last 9 years. As you can see, It's double-digit returns over all periods. It's 15% over the last 3 years annualized. And this is compared to this is a worldwide multi-asset flexible category. It's funds operating very similarly in terms of returns, but the drawdowns obviously would be much deeper because they cannot protect on the downside. And that is the holy grail. That is what we try and do. We want to capture as much of the upside while protecting on the downside. And I think we've succeeded in that. This is just a different way of showing it, but what I want to show here is all the examples that I've used previously as the Worldwide Flexible Fund, but that is a QIF, that's a monthly priced fund. But the two funds that are on all the platforms is the Protea Global Fund and the Protea South Africa Fund. And if you invest in a 50-50, that is the dotted black line. So you can see it gives you a very similar return profile than the Worldwide Flexible Fund in all the examples that I've used. That is just to prove the point. But obviously, people can choose. We also give investors the opportunity to invest according to their geographical preference. If you only want global exposure, the global fund only invests in developed market equities. So you've got that choice as well. This is just an example of how we manage to protect on the downside, and that is by using the short positioning. This is just the top 5 global and South African shorts that we've had. In the middle, you see the price drop while we were short and the contribution to the fund's return. So there are a few things that I want to mention on this slide. Obviously, we look for frauds, fads, and failures. And Wirecard at the top there was fraudulent. And while we were short, the price dropped 98%. But we only contributed 1.3% to the fund's return. Why? Because we do not take concentration risk, especially on the short side. We want to keep the positions very small. We'd rather hit the 1s and 2s than the 6s out of the park. Similarly, I didn't put it on here, didn't make the cut on the South African side, but we made a lot of money on Steinhoff, but with an option. Some of you may have seen the documentary Steinice. We did feature in that. We made the news. So it's obviously, it's not easy to identify these opportunities, so they are few and far between, the fraudulent. But when companies are overvalued, it gives us the opportunity to short a share. We might think that the company is doing a good job, but it is run way too far. And that is just a way to protect on the downside. So just a quick, brief example of a recent special situation. This is, other than longs and shorts, obviously hedge fund exploit these opportunities. And we've identified Natco Pharma on the Adcock Ingram shareholder register in the middle of 2023. The share price is in black and the portfolio weight is in pink. And the announcement came out a few months ago that there's going to be a minority takeout at 75 Rand. And our very perception was twofold, that Adcock would pay a final dividend in September, in addition to the 75 Rand, and that scheme would be finalized quicker than implied. So that's going to happen in November. It's less than 2 months ago. We upped the position at 71.50 Rand. That's only 3.50 Rand from here, and there's a dividend. But if you look at that over a period of 3 months, it's an annualized return on that opportunity of nearly 30%. So again, it's these opportunities are at our disposal that not every fund can exploit. And then very, very quickly, what are our views on the market going forward? And that's a very, very easy answer. We've got absolutely no idea. We don't know what interest rates are going to do. We don't know where the rand's going to be. But you know what? No one else does. And our focus remains on identifying opportunities where there's a valuation gap between price and value. And if it's undervalued, we can buy it. If it's overvalued, we can short it. And that is how we try and manage the fund. And at the end of the day, we don't have to predict what's going to happen. We can build a portfolio that's resilient in all kinds of markets. And I'm going to leave you with this quote of one of the best investors who ever lived. You can't predict, but you can prepare. And I hope that some of what I said resonated. I'm also well aware that after you leave this room, you forgot what everyone said. So if there's one thing that I want you to remember, it is that Protea exists now that you know, and that it can add, hedge funds in general, can add a valuable tool to your clients' portfolios. Thank you very much.
Edric, that was fantastic. Thank you very much. A couple of things that I will remember, especially when you mentioned High School Musical. So the first one I'm going to remember about you is Zac Efron, right? You play golf. I know there's a lot of golfers in the room.
Yes.
And you're very good with mitigating risk and providing upside. There we go.
Thanks, Eugene.
Right, to our audience, thank you very much for being here today. It's always a great pleasure to see you in person. And from Robert Walton, Amelia, Tanya's side, I want to thank you for your continuous contribution. It's been a significant journey over the past 11, 12 years. Came a long way, and now we're also bringing you hedge funds and a lot more. So thank you so much for being here. The presenters here today have done a terrific job, as always, so thank you so much.